All right, well, welcome to our 2022 pre-retirement seminar webinar. My name is Mary Jordan, and I am a senior benefits specialist here with MPERS, and I am going to be your presenter today. We also have Gabrielle Lewis on the call with us, online with us. She is moderating. She'll be online to answer any questions that you may have as we progress through the presentation this afternoon. I do know there's some bad weather going through the central Missouri area. So anybody that's in that area, I hope everyone stays safe, and hopefully the weather doesn't cause us any issues with any of our technology and electronics connections. So I'm going to go ahead and stop showing my webcam. I just wanted to jump on real quick and let you know we are live people. We are still here, and we do hope to be out with our regular presentations a little more next year. But you all should have received an email from me yesterday. For anybody that was already registered yesterday, that contained your retirement estimate or estimates, as well as a troubleshooting guide, and then a link to the reference guide that you can reference later. You know, we're not going to be following along with that reference guide, so don't try to do that, I guess I should say. We're going to go follow along with the retirement estimate as well as share additional information. So that reference guide is good for you later to be able to reference it, follow, read through it, and be in a good format for that, but not so much to follow along with our presentation this afternoon. So keep those estimates in front of you, at least through the first part of the presentation. If for some reason you didn't receive the email, you can always get those retirement estimates from logging into your MyMPERS Secure Member Access account. So let's move on and take care of a few housekeeping items before we get too far into our presentation. This is a picture of the dashboard that you should see as part of GoToWebinar. The first box, just to kind of explain through some of how all of that works, that first little red arrow there is how you can expand or collapse the dashboard. You know, if you're on one computer screen and that box there, that dashboard's in the way, you can collapse it, move it out of the way, then you can always get it back later as well. The next is the microphones. We have muted everyone's microphone today. That will cut down on background noise and distractions for everyone. There's a raise and lower hand feature that we really shouldn't be using for this presentation too much, but it is important, these audio options, audio choices here. You can select how you want to listen to the webinar. You can select computer audio, everything will come through your computer speakers, or if maybe you're in a room with a lot of other employees around, and you can select phone call. You're still watching the webinar on your computer, but if you click on that phone call button, then you'll receive a phone number and a PIN where you can dial in on your phone and listen to it through your telephone. And then there's an option for no audio. The only reason you might want to use that is maybe for some reason you lose audio. If you go click no audio, click back to computer audio, sometimes that kind of resets everything and get everything back up and working again. It's worked for some in the past, that's why we want to mention it. We do have a handout section. You actually have 5 different handouts in that handout section, along with the reference guide that I emailed you the link to for our website. There's copies of the handouts for the insurance presentation and the deferred comp presentation that we'll have today, as well as some other attachments in there. So be sure if you want any of those attachments, you click on them and download them before we end the presentation today. Once we end it, those links go away and you wouldn't have access to those either. And then down at the bottom, another really important part is the questions box. You click on that little down arrow, expand that. There's a place for you to enter in questions. You know, one of the benefits of going to our live pre-retirement seminars is the ability to ask questions. Well, with the webinars like this, you can still ask questions. You're just going to type them in that box down there. And then, as I said, we've got Gabrielle on where she will answer those questions, be able to answer those questions for you, as well as when we take breaks, she can review those questions for everyone, because chances are maybe if you had that question, somebody else has that question too. So they'll be able to benefit, everyone will be able to benefit from any questions that are asked. And then I do want to remind you, we will take a few breaks throughout the afternoon as well. And then we will have an evaluation survey provided at the end of the webinar. And then, but if you're not able to complete the survey today, there will you'll receive that in an email tomorrow or early next week as well, to give you time to do that. There will also be a recording of this webinar available to you, as well as posted on the webinar. So good or bad, if you could please fill out that survey, it'll let us make improvements for future groups. All right, so let's introduce, I do want to introduce our benefits team. You know, the goal of the seminar is to encourage you to think about your retirement and ask questions. So if you were to ask questions, contact us with questions, chances are one of these team members is who you'll be speaking to. I'm listed right there. I have been with MPERS over 24 years, and this is my 16th year as a benefit specialist and doing seminars similar to this. Next, we have Gabrielle Lewis, and I'd notice now that her job title is wrong. I was going to mention it anyway. She was recently promoted to a senior benefits specialist, so congratulations to Gabrielle. She has been with our team over 2 years. She's the newest, but still it's been over 2 years. She came to us from a post-retirement savings plan, so she has a lot of good retirement information to share with you. Next, we have Bev Wilson. She is our benefit audit specialist. She has been with us many years as well. She works a lot on special projects, including auditing all service and benefits. And in doing so, she will also be able to help you through your retirement planning. And we have Julie West. She is our communications specialist, and she has been with us over 3 years. She works on our website as well as with many of the communications that you receive via email. A lot of those may include our monthly newsletters, as well as different information about different specific topics of things that are happening here at MPERS. So let's go ahead and get started, but remember that we will take breaks as we move throughout the presentation today. So this is our agenda of what we will follow today. We will start with the pre-retirement prep. This includes discussions about the different retirement plans, benefit calculations, benefit payment options, backdrop, and the cost of living increases. After that, we'll move on to the retirement two-step, where we will discuss the retirement process and the forms. We will wrap up our presentation with discussions on post-retirement employment, marriage, divorce, death, where to get resources regarding your retirement. And then we've got a few honorable mentions that we will cover as well. So let's get right to it. Question for the audience. How did you prepare for the meeting today? Did you do any homework to prepare? Meaning, have you thought much about your retirement and what you expect it to look like? We hope our discussion will help you do just that. At the end of our discussion today, we will regroup with how to put this knowledge together with other benefits that you might have available to you when you retire. This seminar is going to be very informative, and we'll use general communication to cover the benefit estimate that you have in front of you. So please use this information to guide you in making an educated decision on your retirement. We will not be taking long periods of time to necessarily focus specifically on your estimate. We will provide the tools you need to better understand your options. So let's break down the plans. We administer 3 different retirement plans, and which plan you are in or eligible to retire in will depend on when you were hired. When we talk about being hired, we mean in a benefit eligible position. If you were hired in a benefit eligible position before July 1 of 2000, you're a member of our closed plan. If you were hired on or after July 1 of 2000, but before January 1 of 2011, you are a member of the year 2000 plan. And if you were first hired in a benefit eligible position on or after January 1 of 2011, you are in the 2011 tier. The closed plan and the year 2000 plan are both non-contributory by the member. All the contributions come from your employer. 2011 tier members do contribute 4% of their pay towards their retirement, in addition to those employer contributions. Also, closed plan members have the option to elect to retire in the closed plan or switch to the year 2000 plan at the time of retirement. And more information about those different options will be in a few future slides. So for the most part, we will just be discussing the closed plan and the year 2000 plan today. We shouldn't have anyone in the 2011 tier because we do have another webinar available for those employees to attend as well. So as I said earlier, this webinar will be following along with the benefit estimate. And you should have received that in the email, at least one of those estimates in an email from me yesterday or later yesterday evening. But it is also available in your online secure member access account. So let's first take a look at the estimate. On the estimate here, right below our logo, you have your name listed. In the top right-hand corner, you've got the plan that estimate is for. And then below that, we have your personal information, which includes your date of birth and your spouse date of birth if you gave us one when you registered for the seminar. And we need that spouse date of birth to calculate survivor options. And then below that, we have some other assumptions that we use to calculate your benefits. We show what type of retirement this is for. It'll either be an early retirement or a normal retirement. We show your retirement date for this estimate, and we show your date of termination, which if you're retiring from active employment, it's just the day before you retire. And then we also tell you on the estimate whether this is going to include backdrop or not. It'll say it up here at the top under the plan with backdrop. It'll also say it down at the bottom. Now, any of the information on this first page does not include your backdrop options. That's where it says without backdrop. You'll have a second page that will show you all of your backdrop options. And we'll go through all of those in a later slide also. So as I mentioned, the type of retirement is either normal retirement or early retirement. So let's look at what each of those provide. Normal retirement, both plans have the option of the rule of 80 for normal retirement, which means you have to have an age of at least age 55. But when you reach at least age 55, when we add your age and your service together, when you reach 80, you're eligible to retire. So normal retirement in the closed plan also includes age 65 with at least 5 years of service or age 60 with at least 15 years of service. As a uniform member, you could also qualify to retire at age 55 with at least 5 years of service, and you also have mandatory retirement at age 60. Normal retirement in the year 2000 plan is defined as the rule of 80 again, or age 62 with at least 5 years of service. For 2011 or year 2000 plan uniform members, you also have mandatory retirement at age 60 as well. So we've reviewed normal retirement, but what if you can't wait that long? What if you want to retire early? There may be some options for you. Early retirement in the closed plan is defined as age 55 with at least 10 years of service. Remember, you will take a reduction of 0.6% for each month that you retire before normal retirement. As a uniform member, you don't qualify for an early retirement option because you would qualify for normal retirement at age 55. Early retirement in the year 2000 plan is defined as age 57 with at least 5 years of service. You will take a reduction of 0.5% for each month that you retire before normal retirement. For the year 2000 plan, uniform members also qualify at age 57 with at least 5 years of service. You will take a reduction of 0.5% again for each month that you retire before normal retirement. I think I said that twice. Anyway, not everyone will have an early retirement option. If you came to work at a fairly young age, you may reach the rule of 80 before you would reach any of these early retirement options. And that's okay. You just don't have an early retirement option. So how is my benefit going to be calculated? Our retirement is what's called a defined benefit plan. That means your benefit is calculated based on a formula set in state statutes. We take the amount of your credited service times the multiplier times your final average pay to come up with your monthly base benefit. The benefits listed on your estimates are monthly amounts, and we will only pay them once a month as opposed to twice a month that you receive now. So in the big picture, the more service you have and the higher your salary, the more monthly benefit you will receive. So we will discuss each of these pieces of the formula in a little more detail. So let's start with credited service. Credited service includes membership service. It includes purchased or transferred service and unused sick leave. And we can even break those down a little further. Membership service includes any service that you worked with MoDOT or Patrol, any service that you may have transferred from another state agency covered by MPERS, or any service that you may have purchased and have already completed that purchase. All of that will be listed in membership service. When you look at your retirement estimate and based on the retirement date of that estimate, if that amount of service credit doesn't look right to you, reach out to us. We can tell you what we've included in that and see if maybe we're missing something. You know, we want to get anything corrected if there's anything that we're missing, because that could change your retirement eligibility date or change when your backdrop options, or at least change your benefit amounts. So we want to take a look at that. So there are a few types of service you can purchase that I want to mention. They include non-federal public employment. This service has to be full-time and could include service worked for a city, county government, maybe a public school district, the University of Missouri system, or maybe even some special road districts. This service is limited to service that was worked in the state of Missouri. Another type of service you may be eligible to purchase is military service. The law says you have to purchase all that you're eligible for up to 4 years, and that's service that was worked prior to coming to work for the state. Any service that military service that you work while you're working does not need to be purchased. We give you that time. You'll need to provide the appropriate documentation like a DD-214 or possibly an annual point statement to start the process if you're looking at purchasing that service. Next is police service. This particular option is only available to uniform patrol closed plan members. This type of service works a lot like the military service. You have to purchase all that you're eligible for up to 4 years, and it can't coincide with your employment with the state or any other service that you're getting credit for. The biggest difference with this police service is it's not limited to service worked in the state of Missouri. It could have been worked in another state. But remember that if maybe you have prior police service, but you're not a uniformed, or maybe you're not a closed plan member, you still might have options if it falls under the non-federal public sector employment, as long as it was worked in the state of Missouri. So the options that you have with these type of service depend on whether you still have a future retirement benefit due from another retirement system. If so, you may be eligible to use the value of that future benefit to purchase some of that service here. Either way, we can work with you to determine your options. We can provide you with the cost of a purchase or transfer, as well as retirement estimates that show with and without the service. This will help you determine whether it's worth it. If you have service available, please contact a benefit specialist to discuss your options. Usually, the earlier in your career that you purchase or transfer that service, the less expensive it will be. So your benefit eligible service with any state agency will follow you. For example, if you have service covered under MPERS, you'd be eligible to transfer that service to MPERS. Once the service has been transferred, remember it will show up under that membership service. If you're a member of the closed plan with any seasonal, co-op, intern, emergency snow removal, or part-time service that was considered non-benefit eligible when you worked it, you can receive credit if the employer can verify your employment. This includes telling us how many hours that you worked. So if it is service that you had with MoDOT, we should have access to records. We just need you to tell us that you have that service. If it was with any other state agency, we will need a letter from that previous employer stating your dates of employment and the total number of hours you worked during that employment. You will probably want to start with your human resources section at that previous employer. Remember, state agencies don't have to keep detailed employment records that include hours worked. They don't have to keep them forever, and a lot of them don't. So if you have that kind of service, even if you're not necessarily close to retirement or not ready to retire, get the verification now so we can get it added in. So this is only available if you are a member of the closed plan. However, if you plan to retire in the year 2000 plan, you can still receive credit for this because you're a member of the closed plan now, and that's what allows you to get credit for it. So be sure to get that looked up if you have that kind of service. A few things to remember. The purchase transfers must be completed prior to starting the two-step retirement process. You must be vested to purchase service. It may increase your retirement benefit. It may allow you to retire earlier, and it may get you into backdrop sooner or at least increase the amount of backdrop. When you retire, we will turn your unused sick leave into credited service. It will not allow you to retire earlier, but it will be applied to your benefit. Every 168 hours of unused sick leave equals 1 month of creditable service. Service can only be considered in whole monthly increments. So the sick leave amount that you see on your retirement estimates, also know that was based on your current accrual at the time we ran the estimate. And I believe those were all dated last Friday, July 22nd. So that's not going to reflect the balance that you're going to see when you get your paycheck tomorrow. Those were for the previous pay period. But when you retire, we do go to that final lag payroll and get your sick leave balance. But we also remember, we don't project any of those accruals forward when we run retirement estimates. They're always just that current balance. So to tie all of that in, we have a total, on my examples here, we have a total of 29 years and 4 months of service. Let's see how this example, how we got there. We've got service worked of 29 years, 3 months, and 2 days of membership service. 0 purchase. Your sick leave for mine was 200 hours. I divided that by 168 hours, and I get 1 month of extra credit for that sick leave. So we add all of that service together, and the total credited service to calculate the benefits is 29 years and 4 months. It is important to make sure that you are aware of your insurance benefits and how your service credit could impact how much you pay for your insurance. You know, when we calculate service, we round up at 15 days. We round up to another month of service. When you're looking at your state share for insurance contribution for your employer, they're looking at how much service credit you have. in full year increments up to 25 years of service. So if you're close to that, remember, we round up, but insurance is not going to recognize rounding up. So make sure you talk with them and figure out where you're at, where you're going to be when you retire, so you know how much service credit you have, how much they're going to pay towards your insurance. We don't want you to be a few hours short, where if you worked another month, you get a whole nother bump up another level of how much they're going to contribute towards your insurance. So contact your insurance representative for more information. Additionally, all the information on the estimate, again, is current as of the time that we ran the estimate. So now let's look at the multiplier. The multiplier is set out in state law. This is the one part of the benefit formula that we really don't have any control over. You've been able to control your service by deciding how long to work and when you want to retire, and how much you are paid through promotions or job advances. But the multiplier is the one piece of the formula that we cannot change. The multiplier in the closed plan is 1.6%, and the multiplier in the year 2000 plan is 1.7%. You may also qualify for an additional temporary benefit in the year 2000 plan, and that multiplier is 0.8%. So now let's look at final average pay. So another piece of the formula is the final average pay. This reflects your highest 36 consecutive months of pay. However, we do consider your entire salary history when we're figuring this. And if you look at the bottom down here, this shows you where we came up with that final average pay, that date range. And it also shows what we calculated as that final average pay. So if your estimate is projected into the future, we do not assume any pay raises or overtime. We will project your current base pay forward. So it could increase from what you see today, but it cannot go lower than the final average pay that you've already earned. Now, I know some of you may have seen a salary increase on July 1st. If you did get a salary increase on July 1st, those payrolls were not loaded into our system till this past Monday. So we ran the estimates on Friday. So they're not going to reflect any of that higher salary you might have seen on July 1st. So if you do have an estimate projected in the future, later on, I will show you how to run other retirement estimates where you can see the benefit of that higher salary out there. So also, I want to mention, if you transferred service credit from MPERS, your salary credit also transferred in as well. And that's been used when we figured in all these calculations to come up with that final average pay. So your base benefit, what does this all add up to? So if you look in the middle of the page on your estimate, you'll see the benefit calculation. So let's first start with the closed plan, but let's zoom in a little bit, make it easier. We show taking your amount of credited service times the 1.6% multiplier times your final average pay, and that equals your gross monthly benefit before any deductions. If you were to retire in the year 2000 plan, the formula works the same. We take your credited service times the 1.7% multiplier times your final average pay. And that comes up with your lifetime base benefit. This plan also offers an extra temporary benefit if you're eligible for normal retirement prior to age 62. It's the same formula, just the multiplier is 0.8%. So just remember, the temporary benefit does drop off at age 62, and any cost of living adjustments that you received on the temporary benefit will also drop off. You won't get any more on the temporary benefit in the future, and any that you had already received drop off. but you still have that lifetime-based benefit plus any of the cost of living increases on that lifetime-based benefit. So we have a few items that we need to go over for uniform members in the closed plan. A caveat to the closed plan is that uniform members earn an extra third in their benefit. The extra third is payable for your lifetime, and it also carries over to the survivor benefits. So your calculation has the extra line showing adding that extra third into your benefit. Another option is what's called the special benefit. Closed plan members who were hired before January 1 of 1995 receive an additional $90 per month plus cost of living increases. It is payable until age 65, starts and stops month by month, all the way till age 65. All it takes is an email or a phone call to let us know to start or stop the benefit. And there is also an annual verification that is required to go along with this benefit. That verification is usually sent in January or February of each year. And this extra special benefit is not payable in any month in which you are gainfully employed after retirement. So let's take a quick pit stop. Let's do a few poll questions just to see, kind of recap where we're at. And to answer these poll questions, you'll just click that radio button that's right there on the screen. So the first question says the benefit formula uses credited service, age, and final average pay when calculating your future benefit. Is that true or false? Remember, just use that radio button right there on the screen. Okay, I'm going to go ahead and close that one. And yay, answer. We've got 71% that said false. That actually is false. The benefit formula uses credited service, a multiplier set by law, and final average pay. Age is considered when figuring retirement eligibility and when calculating survivor benefit options. So let's do one more. My sick leave balance can impact the amount of my monthly benefit in retirement. True or false? All right, good responses. Let's go ahead and close that. That one is true. You receive, for every 168 hours of unused sick leave credit you have, you receive 1 month of service credit towards calculating your retirement credit. That goes towards increasing your benefit, and it goes towards possibly increasing your contributions from your employer towards your insurance. It's just not used when figuring retirement eligibility or getting you into backdrop or qualifying you for more backdrop. All right, so let's continue on. So now we're going to take a look at the payment. So this is a chart in the middle of the page, a few lines below your name. The payment options will be listed on the left. Let's zoom in a little bit there. The payment options will be listed on the left here. And then in the middle, you will see your monthly benefit payments. And then in the far right, we show you the amount of the survivor benefit options. And that's how much the survivor would receive at the time of your death based on which different options you might choose when you retire. If you're married, you will have all 5 of these options listed. If you're single, you're just going to have 3. That first one, the life income annuity, and 2 guaranteed payment options. So let's first take a look at the life income annuity option because this is available to everyone. And we're going to look at both plans when we look at these. So with the life income annuity, there is no reduction in your monthly benefit. But that also means there's no survivor option that will be paid. We will only pay a benefit to the retiree when the retiree passes away, the benefit stops. Okay. So next, let's take a look at some other options. If you're married at the time of retirement, you'll have additional payment options, and those will be based on naming a spouse on that retirement election form. So the first option is the joint in 50%. This option shows no reduction in the closed plan. It's free. You can see those benefit amounts don't change there. Then when the retiree passes away and that their benefit stops, the surviving spouse will receive a monthly benefit equal to half of that amount. In the year 2000 plan, there's a reduction in that lifetime base benefit based on the member's age at retirement and the age difference between the retiree and their spouse. There's no reduction in the temporary benefit, but that's because the temporary benefit is not considered when figuring the survivor option. The surviving spouse benefit would be 50% of this lifetime base benefit when the retiree passes away. Another option you will have if you're married is the 100% joint and survivor option. Again, this is only available if you're married at the time of retirement and to the spouse listed on that retirement election form. Either plan will give you a reduction in your monthly benefit, and that reduction in the closed plan is based on the age difference between the retiree and the spouse, or in the year 2000 plan between the age difference between the member and the spouse and the member's age at retirement. A quick mention, again, the temporary benefit is not reduced in the year 2000 plan because that lifetime benefit is what is going to carry on to that survivor for that joint and 100% survivor amount. I know we're kind of bouncing back and forth between estimates, so hopefully all of that is clear to you. Now, the last two options are also available to anyone. These options are guaranteed payment options. In the closed plan, it's 60 months or 120 months, 5 or 10 years. In the year 2000 plan, it's 120 months or 180 months. That's 10 or 15 years. The retiree will receive the reduced base benefit for their lifetime. The reduction can vary based on your age at retirement and the plan you elect to take. So say you're retiring and you're going to take the 120 monthly guaranteed payments. So your monthly benefit is reduced. We start paying you month one in retirement, and say you pass away prior to us paying you 120 monthly payments. When you pass away, we'll start paying your beneficiary the remaining monthly payments. When we get to 120 months, the benefit for that beneficiary stops. The counting period starts at retirement. Okay. But say you live longer than the 120 months as a retiree, we're still going to pay you that reduced monthly retirement benefit. But when you pass away, the benefit stops. There is no survivor benefit because you've passed that guaranteed 120 month period. So you can name anybody as a beneficiary. Remember, the counting period starts at retirement for those guaranteed payments. And the survivor option will terminate after the elected guaranteed payments have been made. And remember also, again, that temporary benefit is not reduced because it's not applied to the survivor benefit. It's only paid to the retiree. And another benefit of the guaranteed payments is you can change the beneficiaries anytime after retirement. Doesn't have to be a qualifying event for those guaranteed payments. You just have the option of changing those beneficiaries. So let's do another quick pit stop, some quick poll questions. All right, if I choose a guaranteed payment option at retirement and I outlive my guaranteed payment window, my benefit stops. True or false? All right. Go ahead and close that one. We were a little more confused on that one, which guaranteed payments are not something that are very familiar with most employees. So, but 58% got that one correct. It is false. Members who outlive their guaranteed payment window will continue to receive their reduced monthly retirement benefit for their lifetime. Upon passing of the member, beneficiaries will not receive future payments since the number of guaranteed payments has already been surpassed. Remember that the guaranteed payment window starts at the time of retirement. So one more question. The temporary benefit is included in the monthly benefit to both the retiree and their beneficiaries. True or false? I think that left off the word beneficiaries. All right, I'm going to go ahead and close that one. And 89% got this one correct. It is false. The temporary benefit is only paid to the retiree, does not carry across to survivors. Get my screens to change. There we go. So let's take our first break. I have 1:12. So let's take a 5-minute break. So we'll come back at about 1:17 or in 5 minutes, and I'll have a clock counting down here on the screen. Oh, it's a 6-minute break. There we go. So I've got a clock there counting. Let's come back at 1:13. All right, so my clock, I've got 1:18, so let's welcome back. Before we jump into backdrop, I do want to reach out to Gabrielle and see if there are any questions that she wants to share with the group. Gabrielle?
Hi, Mary. Thank you, everyone, for having me on here. I honestly think that you've done a really great job of explaining things thus far, Mary. Our questions are very minuscule. We've had some clarity in regards to the joint and survivor and how that applies to the spouse. Both joint and survivor options are a lifetime benefit to the spouse, but do note that all 5 options, payment options that are available, are lifetime payments always for the retiree. There was a comment in regards to someone working currently in backdrop and with the increases that they're currently receiving out there in the state universe, you know, they were wondering if they were going to miss out on some of these. And, you know, if you're working into backdrop, you typically, if you're planning on taking the backdrop, then you could miss out on some of these increases that are currently happening. But if you decide not to take backdrop, then you could maybe increase your monthly benefit by taking advantage of some of these increases if that's where your final average pay rests. But other than that, that's all we've really been chatting about over here.
Perfect. Though I agree, those are great questions. I made some notes to change some things for some future presentations. So we will touch base back with Gabrielle again on our next break and get a recap of any additional questions. So keep the questions going and she will keep answering them. So as we are transitioning into backdrop, some may have this option, some may not yet, but can still work towards earning a backdrop. And backdrop may not work out for everyone. There are a lot of factors that one should consider when making their decisions at retirement. To be eligible for backdrop, you have to work at least 2 years past when you were first eligible for normal retirement. If you qualify for backdrop on the date of the retirement for this estimate that you're looking at, again, you will see a box up in the top right-hand corner that will say with backdrop, or down in the bottom right corner says backdrop estimates on the reverse side. And it's going to be on that second page, all of those backdrop options. So backdrop options are anywhere between 1 and 5 years, depending on how far you've worked past your normal retirement date. Backdrop has to be in full year increments unless it is the maximum amount of time you've worked past when you were first eligible. This example that I've got on the screen here provides a 1 year, a 2 year, a 3 year, or a 3 year and 5 month backdrop. And you will note that you're not eligible to take a 2 year and 5 month backdrop in my example, because it has to be in full year increments unless it's the maximum amount of time you've worked past when you were first eligible. So if you elect to take backdrop, you will receive a lump sum payment in addition to an ongoing monthly benefit. The lump sum payment is 90% of the monthly retirement benefit you would have received had you been retired during the backdrop period. And the lump sum amount that's shown on your estimates is the 90% amount, okay? So the lump sum payment's going to be shown in this darker gray bar, and then your monthly benefit, ongoing monthly benefit options are going to be listed there. And how many options you have are going to be based on when you are eligible to retire and what day you're electing to retire in. So when we talk about backdrop, there are some terms that we use. The first one that we have here is the backdrop date, and that is the earlier date that you would have retired. It could be the same as the date you were first eligible to retire. Otherwise, it's whatever that earlier date is that you elect based on how much backdrop you want to take. So the other term is the backdrop period, and that is the time between your backdrop date and your actual retirement date. So let's look at an example to kind of put into perspective the backdrop period. So if you were first eligible for normal retirement, say on June 1 of 2021, and you work 1 year to June 1 of 2022, you're not eligible for backdrop. You worked 1 year in the backdrop, but you're not yet eligible for backdrop. But maybe you're just not ready to retire yet, so you keep working. If you work until June 1 of 2023, you now are eligible for a backdrop, and you can choose either a 1 year or a 2 year backdrop period. But you decide to keep working until June 1 of 2024. Then you can choose between a 1 year, a 2 year, or a 3 year backdrop period, since those are full year increments. Now let's just say that you want to finish up a project that you're working on. So you work a few more months until November 1 of 2024. Now you can choose a 1 year, a 2 year, a 3 year, or a 3 year and 5 month backdrop period, since that is the maximum amount of time that you're eligible for. This shows the only time that backdrop doesn't have to be in full year increments. And those are the backdrop period examples, how that works. But now let's look at that same example, but look at how the backdrop period works with your backdrop date and kind of go backwards. So if you choose to retire November 1 of 2024 and elected a 1 year backdrop period, that would make your backdrop date November 1 of 2023. If you were to choose a 2 year backdrop date, or 2 years in backdrop, your backdrop date would be November 1 of 2022. Or if you choose to do 3 years of backdrop, your backdrop date would be November 1 of 2021. Then if you choose your maximum backdrop of 3 years and 5 months, then that backdrop date is going to be June 1 of 2021. So the example we've looked at here shows a maximum of 3 years and 5 months of backdrop, and that is based on how far you've worked past your normal retirement eligibility. The maximum amount of backdrop that anyone can take is 5 years. However, you can work longer than 5 years past your normal retirement eligibility. Then if you take 5 years of backdrop, it will be the 5 years immediately prior to your retirement date. I've heard some members say that once they reach their 5 years of backdrop, they'll start losing money. That's not necessarily true, because you will still increase your creditable service the longer you work, and you could shift where your final average pay is. Remember, it can only go higher than what it is right now. So when you elect to take backdrop, the lump sum payment will include cost of living increases based on the plan that you elect to retire in. If you have the option and choose the closed plan and are eligible for the 4% COLAs, which we haven't got into the COLAs too much yet, but they will be included in the lump sum payment and will count towards a COLA cap that we're going to talk about. However, remember, if you choose to retire in the year 2000 plan, the lump sum payment will include the temporary benefit for any months during the backdrop period that you're eligible for the temporary benefit. And it will again also include applicable cost of living increases. So you could see a good amount of difference if you've got the option of both plans. You could see a good amount of difference between those lump sum payments between those. But there's other things that you want to consider when you're looking at that as well. So if you choose to take backdrop, your service and salary earned during the backdrop period will not count. The reason is that we pretend like you were retired on the backdrop date. Remember, we talked about how you would receive that lump sum payment of 90% of the monthly retirement benefit we would have paid had you been retired during that time. then you will also receive that ongoing monthly benefit. So you're going to get an active employee paycheck during the backdrop period, but we're not going to give you service or salary credit based on whatever backdrop you elect to take when you retire, if you're taking backdrop. So note that when you choose to take backdrop, your monthly retirement benefit will generally be less than if you did not take backdrop. The trade-off is that you receive the lump sum payment. You will want to make sure that the lump sum payment is enough to make up for the difference in your monthly benefit. So when you look at the difference in your monthly benefit, if it's more than you can manage, then you may want to look at other amounts of backdrop. So remember, the higher amount of backdrop that you choose, the more years, the lower the monthly benefit will be. If you have, so basically you need to find the right balance for you between the amount of those lump sum payments and the monthly benefits that you receive based on those different options. If you're comparing the lump sum payment between the plans, remember you receive that temporary benefit. And that's when you'll notice that lump sum payment will be higher in the year 2000 plan. So when you choose to take backdrop, you have 3 options for the lump sum payment. You can take it as cash, you can roll it over to an eligible IRA plan, or take the combination of a cash and a rollover. If you take the money as cash, you will receive 1 lump sum payment or up to 3 annual installments. The money is deposited in the same account as your first monthly as your monthly retirement check. The money is taxed the year that you receive it. The IRS requires us to withhold 20% as a prepayment on your federal taxes. We do not withhold any state taxes from the benefit, although it is taxable. And there is potentially an 10% early distribution penalty that may apply to you as well. So basically with that early distribution penalty, the IRS is looking at how old are you when you separate from employment. And the reason I say separate from employment instead of retire is if you retired, say, January 1st of 2023, well, you separated from employment December 31st of 2022. So those are different years, because the IRS wants to know, are you already age 55 when you separate from employment, or will you be age 55 later the calendar year that you separate from employment? If so, that 10% early distribution penalty doesn't apply to you, okay? An example, say you're going to turn 55 in October, you want to retire January 1, say it's all in 2023. So next year, you're going to turn 55 October 1 of 2023. You want to retire January 1 of 2023. Well, but you want to take some of that backdrop as cash, you're going to pay a 10% early distribution penalty because you're not already 55, and you won't be 55 later that calendar year because they're going to look at 2022, not 2023. So in that case, maybe you consider retiring in February. You separated from employment, you retired, and you turned 55, all in the same calendar year. That 10% penalty wouldn't apply anymore. So just keep that in mind when you're kind of thinking about your options and when you want to retire. I also want to remind you, for uniform patrol employees, public safety officers, that age is age 50, not age 55. Okay. And there's more information in special tax notice brochure on that as well. So another option you have for the backdrop is to roll the money over. You tell us what financial institution you want us to send it to. We send that money to them. It can be rolled into your Missouri Deferred Comp Plan. It can be rolled into an IRA or another eligible employer plan. The money is not taxed when it goes into a rollover plan. It's going to be taxed when you draw it out of that receiving plan unless you're rolling it into a Roth IRA. If you roll it to a Roth IRA, you pay taxes when you put the money into the IRA, not when you take it out. So we do not withhold those taxes if they apply. If you're rolling it to a Roth, you would be responsible for paying those. So just remember, when money is rolled in to another plan, it takes on the tax characteristics of that other plan that it's rolled into. So you'll want to talk to your manager of that other plan to make sure you know what the tax consequences are of rolling it there. You also have the option of doing a combination of a cash and a rollover. You decide how much you want to roll over. Then we will send the remainder to you as cash. We will withhold 20% in federal taxes just on the cash portion. Remember that you will still be responsible for paying the state taxes as well as any additional federal taxes that may apply. Again, we've got a special tax notice brochure available on our website that will provide additional information regarding your taxes and the distribution of the backdrop. So why don't we look at our first real life example? We've got Janie, and she is retiring at 61, and she's single. She has 28 years and 8 months of service, and she's eligible under the rule of 80. And she's considering the year 2000 plan with that temporary benefit to help her get her by until she can draw reduced Social Security at age 62. But wait a minute. Who takes the year 2000 plan at age 61, knowing that the temporary benefit stops at age 62? But she's told us that she can't work any longer. She's ready to get out, but she needs that temporary benefit to help pay her bills. So let's look at her benefit amounts. If she takes no backdrop, her monthly benefit will be $2,489 a month. But if she takes a 5-year backdrop, her monthly benefit will go down to $1,866 per month, and she'll receive a lump sum payment of almost $93,000. She'll take over $600 less per month for the rest of her life to get $93,000 lump sum payment at retirement. So let's look at the advantages and disadvantages. Janie can pay off her debts, and she can put an additional $20,000 into deferred comp and at least earn interest on that amount. Disadvantages, she receives $623 less per month for the rest of her life. Her mother is still living at age 90, and if she lives until age 90, that's a total loss of over $130,000 plus cost of living increases. So what did Janie do? She took the full 5-year backdrop. She's paid off her debt, and she has a small savings in deferred comp, which she has never had before. Good choice or bad? Janie has made the peace of mind, or she has the peace of mind knowing that the decision she made was the best for herself, even if it's not the same decision that others might have made. You know, we want to show you these examples to know, give you some idea of what to think about, what goes into making a decision of which plan or backdrop or some of those things. And these are real life cases. We've just changed names and maybe changed a few things, but these are real life situations that have happened. You know, as we're working through retirements each month, we look at these different things. We may contact you and say, hey, you know, we just want to make sure you understand, you know, the decisions you made. Here's some of the consequences, or here's some of the options. Make sure you understood the options. You know, we're not trying to change your mind. We just want to make sure that you understand the decision you made, because once we pay you that first payment, there's a lot of things that we can't change anymore. So we want to call you. We may call you, but we're not trying to change your mind. We just want to make sure that you understand your options. So let's do a quick pit stop here. Hopefully get all the information while it's still a little bit fresh. So if I work past normal retirement date, or if I work past normal retirement, normal retirement date, salary increases, comp payouts, and overtime payouts will not be included in my final average pay. True or false? All right, I'm going to go ahead and close that one. Good job. 78% are correct. The answer is false. We track your salary all the way to your retirement date. However, if you elect to take backdrop, we will only consider your salary earned prior to your backdrop date. In most cases, backdrop would reduce your monthly benefit. We have an example coming up where a member made more in backdrop than not taking backdrop. So let's hide that one. So now let's take a look at how you can run your own retirement estimates from your MyMPERS Secure Member Access account. This can be found on our website by going to www.mpers.org and clicking on the green box in the top right corner that says MyMPERS Login. This will take you to this screen. If you already have a username and password, you can enter it here. If you do not have one, you can click on Enroll Now. I know I've got a slide at the very end, but we did add an extra step in the enrollment process now. So there is multi-factor authentication where you're going to have, if you don't have an account already set up, you're going to have to request a PIN number in order to be able to set that up. But either way, if you have any trouble getting logged in or getting your account set up, please contact us. We'll be glad to help you get through that. So once you're signed in, you will want to click on Estimate a Benefit over here on the left side. You know, everything that you can do as a retired or as an active employee is what's listed in that list down the left side. So Estimate a Benefit is one of those options, and it will show you, it will pull up this screen here. There we go. So first thing it's going to show you is when you're eligible to retire. If you're eligible in both plans, it will show you both plans. If you've got a difference between early and normal retirement, it will show you those different early retirement dates as well. The first option for running estimates is option 1. That's using either your first eligible for normal date or first eligible for early retirement date. You just move those radio buttons. Another option down on option 2, if you want to select that, move that radio button down, and maybe you have a retirement date picked out. You know, maybe you're looking at backdrop or you've got a retirement date into the future. You enter that date in there. A third option is, and again, move that radio button, is maybe you have a job offer outside of state government and want to see if you leave, when would you be eligible to retire and how much would that benefit be when you could start drawing it. So you can run those options. And then down at the bottom, you can enter a spouse date of birth if you're married. So that will show those survivor options. And then you click Generate Estimate all the way down at the bottom. The completed estimate can be found under your estimate history down that left side, right below that Estimate a Benefit. Those estimates that you run are stored out there for 30 days unless you delete them. Note that we update service and salary and your unused sick leave twice a month with your active employee payroll. And that is usually around the 10th and the 25th of the month. All right. So let's move into cost of living increases, because this is really important to having your benefit keep up with inflation. It's a really important part of your benefit as a whole as you progress through retirement. So these lifetime COLAs are paid to retirees in the year 2000 plan and the closed plan, as well as survivors, beneficiaries, and most ex-spouses under a divorce award. So how we calculate the COLA and when it is paid is set in state law. The COLA is based on 80% of the percentage of change in the consumer price index, the CPIU, and can range from 0 to 5%. For example, this year, the COLA is 3.758%. Last year, it was 0.987%, and we could be looking at a record year next year. We'll have to see what the rest of this year looks like, but it's higher because inflation's higher, so there's trade-offs there. You can find a history of our cost of living increases in the reference guide as well as on our website. So closed plan retirees receive their COLA in October, as long as they're retired at least in September. And the year 2000 plan retirees receive their COLA on the anniversary date of their retirement or the backdrop date if they're different. An exception to the rule is that if you're a closed plan member that was hired in a benefit eligible position prior to August 28th of 1997, the amount of your COLA will be different initially. You're eligible to receive a guaranteed minimum 4% COLA until you reach 65% in increases. We call that the COLA cap. These COLAs are still given in October though. So that means that if your initial retirement benefit was $2,000 and 65% of $2,000 is $1,300. So your COLA cap would be $1,300. We then add $2,000 base benefit to the $1,300 COLA cap to get $3,300. So as you progress through the years in retirement, your benefit increases and get your benefit increases. When your benefit reaches $3,300, you would no longer qualify for the 4%, and your annual COLA would revert to 80% of the change in the CPIU. So you would still receive a COLA, just the percentage of the increase will change. You would receive 4% or the 4% COLAs for basically the first 12 years, and in the middle of the 13th year, you would reach that COLA cap. Also remember that if you take the backdrop, that COLA, or that will use some of those 4% COLAs, so the counting period for the 12 years would start on your backdrop date instead of your retirement date. You don't lose out on those COLAs, you just use part of them during the backdrop period. So let's work on our second real life example. This is Brenda and CJ. Brenda is retiring at age 60 with 29 years and 11 months of service. She will qualify for the rule of 80. She's been the primary supporter of the family, while CJ has managed the finances. Brenda is looking to take the full 5-year backdrop because she wants that huge lump sum payment of $140,000. If she takes the 5-year backdrop, her monthly benefit will be about $2,800. But since she has seen some pretty significant increases in her salary over the last 3 to 5 years, if she didn't take the backdrop, her monthly benefit would be about $3,600. She would be taking over $800 less per month to take a 5-year backdrop and get $140,000. So let's talk about some of the pros and cons for Brenda and CJ with that 5-year backdrop. Advantages: they'd be able to pay off debt and retire debt-free. They'd be able to put an additional $100,000 into deferred comp to increase their post-retirement nest egg, and she can earn interest on that money in that account as well. Disadvantages, Brenda would receive $816 less per month for the rest of her life. And CJ is just not sure that they can live on that much less per month, even with that additional deferred comp, or additional money that they're going to be able to put into deferred comp. So what did they decide? She took a 2-year backdrop and was able to pay off their debt and put a smaller amount into deferred comp, and she'll have more money per month. And CJ can rest easy knowing he's not going to have to give up playing golf. So this is where you can see that taking the maximum amount of backdrop does not always work out for everyone. By taking the 2-year backdrop instead of the 5-year, Brenda is still able to roll over $70,000 to deferred comp, and her monthly benefit will only be about $300 less. So she found the balance for them between the amount of the lump sum payment and the amount of her monthly benefit. As some have been getting increases this year, you've seen increases. If you're coming up on being eligible or looking at backdrop and those things, some of these scenarios may be of more importance to you compared to if you saw those examples last year, because your salaries may be changing more. So now that we've kind of let that scenario sink in, let's take a look at another real life example. Remember, we just looked at Brenda and CJ. Brenda wanted to take the full backdrop because she wanted that large lump sum payment. But CJ was worried about taking that much less in the monthly benefit. Well, Ava and Jim's situation is the exact opposite. So if Ava retires in the closed plan with no backdrop, her monthly benefit will be $3,548. And if she retires with the maximum backdrop of 3 years and 6 months, her monthly benefit is $3,564. She would actually see an increase in her monthly benefit, as well as receiving a lump sum payment of over $127,000. The reason this happens for Ava is because she has no change in her final average pay if she takes no backdrop or the maximum backdrop. Then, since she's in the closed plan, she's qualifying for the guaranteed COLAs. She will receive the guaranteed 4% COLA during the backdrop period, even though she will have 3 years and 6 less months service. The 4% COLAs can make up for that difference. This is not a scenario that will work out for everyone, but it will for some, and it will only happen in the closed plan and only if you're eligible for those 4% COLAs. So a big decision for anyone in the closed plan is to decide whether to stay in the closed plan when they retire or switch to the year 2000 plan. There are several key factors to consider. First one is the multiplier. It's 1.6% in the closed plan versus 1.7% in the year 2000 plan. The temporary benefit, you get it in the year 2000 plan, you don't get it in the closed plan. The 50% joint and survivor option, it's free in the closed plan, but you'll take a reduction in the year 2000 plan. Next, cost of living increases. Some qualify for the guaranteed 4% COLA initially in the closed plan. It is not available to anyone in the year 2000 plan. And then another consideration for some is that the eligibility requirements are different in the plan, different between the two plans. But remember, both plans have that rule of 80. So knowing these differences, what is a benefit to one may not necessarily be a benefit to another. So consider your options carefully when you're looking at your retirement. So to help you balance some of these decisions, we have a comparison program available in your MyMPERS Secure Member Access account. I think it's in the forms section, and same place the notice of retirement form is listed. If you're in the year 2000 plan, you can compare whether to take backdrop or not take backdrop. If you're in the closed plan, you can compare retiring in the closed plan versus retiring in the year 2000 plan, or whether to take backdrop or not. This program will allow you to find the break-even point where one option or plan catches up to another option or plan. So let's look a little bit closer into how this program works. So this one is where you're comparing the closed plan or the year 2000 plan. The boxes that are shaded yellow, those are the boxes that you're going to look at filling in. You've got to have a retirement estimate in front of you, because this is just an Excel. These are Excel spreadsheets. So you've got to have the information to enter in already. When you're looking at entering in those boxes, if you're not sure what to enter, if there's a little question mark next to it, if you hover your mouse over that question mark, it's going to pop up with a little box. It's going to show you where on your retirement estimate to find that information. So you just go through and fill in what's asked on those questions. I do want to point out this fourth question if you're looking at anything with the closed plan. The fourth question says, were you hired in a benefit eligible position prior to August 27th of 1997? And you enter a yes or a no. That's basically, do you qualify for those 4% COLAs or not? So be sure you enter that based to get those COLAs right. The next one is what kind of a future cost of living increase do you want to assume? There's drop downs for most of these options too. Then you enter in your monthly benefit amount. You enter in your year 2000 plan benefit amount, lifetime and temporary benefit separate if you have the temporary benefit. If you're electing backdrop, enter in your backdrop dates as shown on that retirement estimate. There's going to be a couple other boxes that are going to show up, and one of them is going to be entering in that lump sum payment amount for backdrop. When you filled everything in there, there's a part of the bottom half of the screen is changing all kinds of information. This section on the left is just comparing the difference between your monthly benefit amounts. In this example, again, closed plan shows what your benefits started out as, and then adds cost of living increases, whether you get the guaranteed 4% or whether you have that assumed COLA that was entered in up at the top. Year 2000 plan, same thing. There's never a 4% COLA, guaranteed 4% COLA. So it's going to add whatever you've assumed for those COLAs. And when you turn 62, the ages are in this column here. When you turn 62, the temporary benefit stops. So whichever column is shaded, that's the plan that's paying you the most money at that age, based on the assumptions from above. Basically, while you're getting the temporary benefit, probably the year 2000 plan is going to pay you more money. When that temporary benefit was over, well, closed plan would pay you more money. But when you look over here on the right, this is your estimated cumulative payouts. So the first year that you're retired, how much did we pay you in each plan? Second year, and that may have just been a partial year. Second year, how much did we pay you that second year added to what we already paid you? Now you're up to a total of the amounts that are listed there. Keep projecting all those benefits all the way down the screen. Again, whichever column is shaded, that's the plan that's paying you the most money. So when you get down here to age 60, or well, in my example, 68, 69, whatever that break even, whatever that shading changes, that's your break even. That's where the benefits of one plan caught up to the benefits of another plan. Or if you were just comparing backdrop and no backdrop, that's where the benefits of not taking backdrop and maybe having a higher monthly benefit caught up to taking backdrop without lump sum payment. So those are some options to be able to run some different figures, maybe help give you some extra information to make a decision with your retirement. If you're running these estimates or this comparison calculator, you've got questions about it, call us. If you want us to run it for you, not a problem. Give us a contact a benefits specialist. We can help you with that as well. Oops. So, whoop, I went too far. There we go. So let's take another, a look at another real life example. Let's meet George and Lou. George is retiring at age 65. He has 25 years and 3 months of service. He qualifies to retire under the rule of 80, and he's considering taking the year 2000 plan with the temporary benefits so he can get that huge lump sum payment. But wait, who takes the year 2000 plan after age 62? So let's take a look at George's options. If he takes the closed plan, his monthly benefit is $1,719 per month. To take the joint and 100% survivor option, his benefit is reduced 7%. This is based on the age difference between George and Lou. So, but if he takes the year 2000 plan, his monthly benefit will be about $1,848 per month. This is higher because the multiplier is higher in the year 2000 plan. But to take the joint and 100% in the year 2000 plan, he will take an 18% reduction in his monthly benefit. This is higher because there's no free 50% option in the year 2000 plan. And again, this reduction is based on his age at retirement and their age difference. So George is interested in taking the backdrop because he has some medical bills that he needs to pay off to be able to afford to retire. He wants that huge lump sum payment in the year 2000 plan. He also wants to take the joint and 100% option because of his health issues and wants to make sure that his spouse is taken care of. So if George takes a 5-year backdrop, we will reduce his service down 5 years and reduce his benefit by 7% for the joint and 100% survivor option in the closed plan. Then we will apply the 4% COLAs. We will apply 5 4% COLAs. So we reduced his benefit by 7%, but will increase it by over 20% in the closed plan. That's an overall reduction or overall increase of about 13%. That means that his closed plan benefit went down to about $1,553 per month. But he's going to get a lump sum payment of $82,000. But if George takes the 5-year backdrop in the year 2000 plan, we will again drop his service down 5 years. And this is a big reason why his benefit drops down. We're getting those 5 years down. And we reduce his benefit by 18% for the survivor option. Remember that he will not get a guaranteed 4% COLA in the year 2000 plan. So if he receives an average of say 2% per year, that would be 10% in COLAs over 5 years of the backdrop. So we reduced the benefit by 18%, but only increased it by about 10% for the COLAs. This is an actual reduction of 8% in the year 2000 plan. This means that his benefit in the year 2000 plan with backdrop went down to $1,364 per month with a lump sum payment of $93,000. So remember that George wanted to take the year 2000 plan for that huge lump sum payment that will only be about $11,000 more than the closed plan. And his monthly benefit will, for the rest of his life, will be $189 less. So what did George decide? After comparing the estimates through the comparison calculator, that comparator, and having a one-on-one counseling session, George decided he would take the full 5-year backdrop in the closed plan, use the lump sum payment to pay off his medical bills and outstanding debt. He will bring home $189 more per month, and Lou will have that same 100% monthly benefit for her lifetime when George passes away. And remember, that monthly benefit is higher too of what she's going to get. So good choice or bad, you know, ultimately it's his decision. But based on all of these scenarios and what we know about the situation, we think he made a pretty good decision. So another topic that we want to touch on briefly is disability benefits. So we kind of put on a different hat to start talking about something different. You might think that you won't have to use the disability since you're nearing retirement. However, they still could benefit you. Disability benefits are actually meant to bridge the gap between when you are no longer able to work and when you're eligible to retire. Say you are 2 years from being eligible to retire and something happens and you can't work. If you meet the eligibility requirements and continue to be disabled, you could stay on disability until you're eligible to retire. Then you would be required to retire in most cases. So there are 3 different types of disability: long-term disability for any illness, injury, or disease; work-related disability for any accident or injury on the job; and then there's workplace possibilities, and it works a little bit different. This program is actually meant to help you stay at work and get you to your retirement. An easy example is to say you have back trouble and are being treated by a physician. Our disability provider can send someone to review your medical documentation in your work area. They may look at your chair and say, that's causing you a lot of trouble. They will go out, they can go out, they can buy you a new chair to help. This is at no cost to you and no cost to your employer. They figure if they can keep you at work, they will pay less in disability benefits. Remember, this is only a one-time shot per incident, and you can't be eligible to retire. Disability benefits will not pay you 100% of your pre-disability salary. So if there's a way to keep you at work, you're going to have a higher income. But the disability benefits are there if you do need them also. So let's do another pit stop. So next question: benefit estimates can be run at any point in your career through MyMPERS Secure Member Access. True or false? All right, I'm going to go ahead and close that one. So 94% said true, 6% said false. It's true, the estimated benefit feature in your MyMPERS account is convenient and an important tool to use as you are planning for your planning and strategizing for your retirement. Maybe those 6% were thinking about the times where they either couldn't get logged in or the system has maintenance or something. But we'll go with it. The answer was true, though. All right, next question, just one more again. I will always be eligible for a COLA increase in retirement. True or false? This turned into a tricky question, I'm seeing. All right, I'm going to go ahead and close that one. This one actually was split 50-50, exactly 50-50. Well, we go with the answer is true. You will always be eligible to receive a cost of living increase or a raise in retirement. The percentage will be determined on your hire date and the plan you retire under. The closed plan offers that 4% COLA until you reach 65% of the COLA or increases, which is the COLA cap. And that's if you were hired in a benefit eligible position prior to August 28th of 97. And then there's the COLAs with the year 2000 plan or anybody that doesn't get the guaranteed. Now the percentage is going to change. So, it's based on whatever happens with the CPIU. So the percentage could be 0. So that could make somebody want to say false, but the plans at least always, no state appropriation, no budgeting. State law says how we calculate the COLAs and when we give them. So that's hopefully a comforting effect with those cost of living increases. All right, so I'm going to remember this time before we go into our next break. Gabrielle, do you have any questions that you want to share with the group?
Hi, thank you. I actually just received some kind of personal communication that may not benefit the group in totality, and I know one part you're going to be covering here, and that's with the take-home pay calculator. So I'm really just going to let you approach it in this next section. There's nothing else to share during this section.
Okay, perfect. Well, we'll go ahead and take a break. And if you've got questions during the break, feel free to ask those as well. We will recap questions again before we finish up with my section, or for the MPERS part of the presentation. So let's take another 6-minute break. I've got 2:09, so let's come back at 2:15. All right, well, welcome back. Let's move on into our next section, section, if I can say that right. Let's look at the retirement two-step. When you're ready to retire, we have a two-step retirement process. The first step is the notice of retirement, and the second step is the retirement election form. So the notice of retirement is where you notify us of your expected retirement date and provide your spouse information if you're married. There is also an acknowledgement right above your signature to check that you do not have a pre-arrangement to return to work with any employer covered by MPERS or MOSERS when you retire. And we're going to discuss the details of all of that in just a few minutes. But you can submit your notice of retirement online through your MyMPERS Secure Member Access account, and it will go directly into our workflow to be processed. Or you can print the paper form from our website without signing in, but then you'd have to get that form to us somehow. If you do have the paper form, there is additional information on the back of that page. It includes a chart that shows when the forms are due. Notice the deadlines and don't miss them. If you miss a deadline, we might have to push your retirement date off. Part of the process also includes submitting acceptable proof of age documents. This could include a birth certificate, a US passport, or a valid Missouri driver's license. We only need one acceptable proof of age document for you, and if you're married, one for your spouse as well. We also need an acceptable proof of marriage document from you as well. Remember that we only need photocopies of these, and they can be submitted either with the notice of retirement or with the second step or anywhere in between there. We just need them before we can pay you. So once you've submitted the notice of retirement, we will turn around and send you a packet that will include all of the remaining information that you will need to finalize for your retirement with MPERS. And this packet includes a designation of agent form. And this basically works like a power of attorney if you didn't already have one. It only works on your benefits from MPERS. It allows you to name a primary and a secondary agent that you want to be able to act on your behalf if you were to become incapacitated and not able to make decisions on your own. This form will not completely take the place of a power of attorney, just provide some options with your benefits with MPERS if you don't already have a power of attorney. Next is the $5,000 death benefit beneficiary form. This benefit is provided at no cost if you retire from active employment. We just need to know who you want to name as your beneficiaries, and you can always change those beneficiaries after you retire. The next form is a tax form. This is where you tell us what taxes you want to have withheld from your benefit. Also, remember, you can always change your taxes later as well. This is just what you want to have to get started with your retirement. Next, direct deposit form. Tell us where you want us to deposit your check each month. You know, everything you have set up with your employer now as an active employee, all of those deductions, all of those options, they stop when you retire. It doesn't carry across to your benefits with us. We're a completely separate payroll system. That's why we need you to fill out these other forms. Next form is a backdrop distribution form. If you're eligible, it will automatically be included in that packet. If you decide not to take backdrop, not a problem. Just don't fill out that form. You don't need to return it to us. And then last, we include retirement estimates that are customized for you based on the information that you included on the notice of retirement. And then last is the retirement election form. This allows you to tell us which plan you want to take. If you have that option, what survivor options you would choose, and if you're eligible for backdrop, do you want to take backdrop and how much? Then at the bottom of the form, you would sign and date at the very bottom. Any and all of the forms and supporting documents for us can be submitted electronically. we do not need the original copies. However, we do caution against emailing Social Security numbers and banking information. Please consider using a fax machine or encrypted email option. We have a secure document upload feature on our website that provides you with an encrypted email option. You can find that button right on the front screen, top right corner, right below the green button that says My MPERS Login. There's a secure document upload, a big yellow button there, gold, dark yellow, gold button. If your employer has encrypted email options, that's fine. You can send them to us that way, but just make sure you keep your information safe. So just a reminder about a few additional items. We only pay benefits once a month, the last working day of the month for that month. Backdrop is paid at the same time as your first monthly retirement check. And once you're finished with all the paperwork with us, you're finished with MPERS. However, you are not finished with your employer. You need to contact your insurance representative to discuss their paperwork. Remember the deadlines. Don't miss them. Your employer has different deadlines than we do, and some of them may be earlier than ours. So make sure you're working with them as well. So as we wind down our discussions, let's take a look at our last couple. This is Sam and Janet. Sam came to work for the state later in life. He has 10 years of service and was told by coworkers that backdrop is a great deal and that they should take it. Well, Sam's options are to take no backdrop or up to 5 years of backdrop. If he takes no backdrop, his monthly benefit would be $491 a month. If he takes a 5-year backdrop, his benefit would drop to half to $234. He would lose over $250 a month to get just over $11,000 up front as a backdrop lump sum. It would take over 4 years of that higher monthly benefit to equal $11,000, meaning it would take over 4 years for $250 to add up to $11,000. So if he took the higher monthly benefit after 4 years, he would have received more money from us and continue to receive a higher monthly benefit. So ultimately, they decided to take no backdrop. The higher monthly benefit meant more to them than that lump sum payment. Remember that water cooler chit chat is not always the best advice. What's a great deal for you might not be a great deal for the other person. And when a respected, influential coworker tells someone that it's a great deal, we have a much more difficult time helping them understand why it might not be in their best interest. So we don't want you to not talk about retirement. We just don't want you to possibly tell somebody what to do, just because everybody's situation is just a little bit different. So let's go through our last section now and kind of wrap it all up with a bow. So let's talk about working after retirement. No matter how much or no matter which plan you elect to retire in, you can go to work for any non-state employer and still receive your monthly retirement benefit. This could include a city or county government or private industry. The plan you retire under will determine what options you have for returning to state employment after retirement. If you retire in the closed plan, you can go to work in a benefit eligible position for a MOSERS covered employer and still receive your monthly retirement from MPERS. However, if you retire in the year 2000 plan, your benefit will be suspended while you're working. You can retire in either plan as a non-benefit eligible state employee that's under the 1,040 hours in a year and still receive your benefit. We usually hear them being called working 1,000 hours. I also want to remind you of an IRS requirement. with regards to reemployment with a state agency. When you're planning your retirement, you need to make sure you do not have a prearrangement to return to work with any state agency, either benefit eligible or non-benefit eligible, before you have retired. And you must have at least a 30-day break in service before returning to work with any state agency. Again, either benefit eligible or non-benefit eligible. So remember, Mosher's does include some colleges and universities. So keep that in mind if you're looking at other employment post-retirement. If you're considering going back to work post-retirement, we would encourage you to contact a benefit specialist to see how it might impact your retirement, impact your benefit from us at any time later on down the road as you're progressing through your retirement. Okay, so if you were to get married after retirement, there are only 3 circumstances that will allow you to change the payment option you've elected at retirement. So if you were single at retirement and elected the life income annuity option, later find your soulmate and get married, you have 1 year from the date of marriage to name your spouse for a survivor option. Or if you are married at the time of retirement and elected a joint and survivor option, then your spouse passes away, we would pop up or remove the reduction at that time. Then if you later remarry, you will have 1 year from the date of marriage to name your new spouse for a joint and survivor option. Or another option is actually based on a new fairly recent law change. If you're married at the time of retirement and elected a joint and survivor option, you later divorce and submit an acceptable divorce decree or amended divorce decree that removes the spouse option. So your benefit, your retirement benefit pops up. Then if you later remarry, you will have 1 year from the date of marriage to name your new spouse for a joint and survivor option. All of these changes generally take effect the month following when we receive the paperwork, depending on what time of the month it's received. Okay. So we've talked about what happens to your benefit if you get married. Well, now let's talk about what happens if you were to get a divorce. Your benefit is considered marital property, and it can be divided by a court based on what if you were married while you were still working. So for a divorce before retirement, if you are married while you're working and get divorced while you're still working, the court could award your ex-spouse up to 50% of the benefit that was earned during the period of the marriage. For a divorce after retirement, if you retire, take a joint and survivor option, and then get divorced, the spouse you named on the survivor option, for the survivor option on that retirement election form, will still receive the survivor benefit when you pass away. In addition, if you were married while working, your monthly benefit can still be divided by the court. So also remember the option we just talked about on the last slide, and a recent change in the law that took effect on January 1 of 2021. If you have a joint and survivor option and get divorced, the court can issue a divorce decree or amended divorce decree that has specific language to remove your spouse from the survivor benefit and remove the future reduction in your benefit if you had one. If you are in this situation, we would encourage you to contact a benefit specialist before finalizing your divorce so that we can provide information about what needs to be included in that divorce decree. If the court divides the benefit, they will issue what's called the Division of Benefits Order, or DBO, for us to pay up to 50% of the monthly retirement benefit that you earn during the period of your marriage. The DBO will terminate at the death of either party. I also want to mention that you might have the other options besides the DBO. That it has nothing to do with us. We wouldn't be involved in any part of it, but you might also be able to do a property settlement. That is to say that maybe you can give your spouse the house or part of your deferred comp in exchange for them not taking part of your monthly retirement benefit. Another thing for you to remember is if you are going through this process, that if you divorce before retirement and a DBO is issued, a monthly payment will not be paid until you retire and start receiving a monthly retirement benefit. So your ex-spouse would not get paid until you retired and started getting a payment. So let's talk briefly about what happens if you pass away. Everybody always thinks retirement's all fun and games, but unfortunately we do have some other stuff we have to work with. So if you pass away before retirement, the spouse you're married to at the time of your death will receive a joint 100% survivor option, the most that they can get. They will receive this benefit for their lifetime, even if they remarry. Or if you're not married and have children under the age of 21, we will pay them a benefit until they turn 21. If you have no spouse or children under 21, then no benefits will be paid. But remember, that's not the case necessarily for somebody in the 2011 tier because of those employee contributions. So theirs works a little bit different. But also, if you pass away after retirement, survivor benefits will be paid based on the elections you made at the time of retirement, keeping in mind if a pop-up happened or a new spouse was designated when eligible. After retirement, we will also pay any final payments to the designated beneficiaries as necessary, and we would pay the $5,000 death benefit if eligible at retirement. So before we get into the resources to share information with you, I want to share how you can securely submit information to MPERS, like the proof documents in your retirement packet. So I already kind of mentioned this, but let's look at it a little more. So this is that yellow box, the secure document upload box in that top right corner. The process will allow you to send an encrypted email with attachments that include personally identifiable information and possibly banking information. Please do not email personally identifiable information or banking information that is not encrypted somehow. You can also fax the information to us as well. You might be thinking, how in the world am I going to remember all this information? Well, luckily, you don't have to remember the information. You just have to know where to find it. Our website has a lot of great member education pieces as well as resources for you. A question that we receive quite often is, what will my take-home pay be? One of the resources located on our website is a take-home pay calculator. You know, it's great to know how much your gross benefit's going to be, but that's not what you're going to have to live on. It's that take-home pay. So this is what the take-home pay calculator looks like. It allows you to enter in your specific filing status to calculate federal taxes. You enter in your gross monthly benefit and it'll calculate those federal taxes. It gives you a place to enter in state taxes and also other deductions of medical insurance, optional life insurance, dental, and vision insurance. One thing I do want to mention with the state taxes, there is a public pension exemption. We have nothing to do with how all of, whether you qualify for this, but we're just giving you the information for it. Missouri Department of Revenue handles everything otherwise when you file your taxes. So the public pension exemption says if you're married filing jointly and your adjusted gross income is less than $100,000 in a year, or if you're single and your adjusted gross income is less than $85,000 in a year, then you wouldn't owe state taxes on the first about $40,000 of a benefit that we're paying you. Okay. Again, I mean, this is year by year. So if you go over 1 year, January 1st, you start new on a clean slate. But again, we don't have anything to do with determining whether you qualify. You would want to talk to your tax professional to see how that may be of service to you or be of an option for you. And the other deductions, medical insurance, optional life insurance, dental and vision insurance are only those that are available through Missouri Consolidated Healthcare Plan. These are the only deductions that are eligible to come out of your check, and it's only what you tell us that you want to have withheld from your check. So let's do another quick pit stop. Last 2 questions we've got for the afternoon from me. First one, if I am not married at retirement, I can choose the joint and survivor payment option just in case. True or false? All right, I'm going to go ahead and close this one. Let's share the response. 94% said false. Yay! The answer is false. Unmarried members may choose from the life income annuity or guaranteed payment options. If they marry later, they have 1 year from the date of marriage to change their payment option to a joint and survivor if they wish, but only if they elected the life income annuity at retirement. So last question. If I retire under the closed plan, I can go to work full-time for a Mosher's covered agency and continue collecting my benefit. True or false? This one may be a little trickier since it doesn't necessarily apply to everyone. So let's go ahead and close that one. I will share 73% got it correct. It is true. Closed plan members can continue to collect their MPERS retirement benefit while they're working in a benefit eligible position covered by Mosher's, such as Department of Corrections, Department of Conservation, Missouri State University. Just remember, you cannot have a pre-arrangement to return to work prior to your retirement. You must have at least a 30-day break in service before you return. All right. So let's go through our list of honorable mentions. So your MPERS benefit is just one part of your overall retirement success. There are many other things that you want to consider. While MPERS provides some level of income, it may not serve as your total replacement income. For example, if you're retiring under the closed plan and you have 25 years of service, if you multiply the years of service 25 by the plan multiplier for the closed plan, 1.6%, your income replacement will be about 40%. Where is that additional 60% going to come from? Hopefully by this point, you have some kind of personal savings built up, maybe through the deferred comp plan or a different savings vehicle. This will help supplement your retirement income. Another additional saving or additional source of income could be Social Security. You may be able to draw early reduced Social Security at age 62, or maybe you could wait and draw Social Security years down the road. However, until you're eligible to draw, there may be a bit of a gap in your retirement income. Will you have the temporary benefit to help with that gap? Another, what are your plans for health insurance? Are you going to continue your MoDOT or patrol insurance into retirement? Or do you have other plans? Health, dental, vision, and life insurance premiums are eligible to be deducted from your retirement benefit, but keep in mind that the health insurance premiums will increase at retirement. Dental and vision premiums have the potential to increase. However, since they're not subsidized by the state, those increases will most likely be fairly minimal. Optional life insurance premiums will increase when you hit those 5-year milestones. At retirement, you will complete a W-4P for withholding on your MPERS retirement benefit. However, this doesn't take into consideration any other sources of income you may have. The only tax advice we can give you is to speak to your tax professional regarding any of your tax questions. Keep in mind that if you need to make an adjustment to your withholdings on your retirement benefit, you can do that at any time of the year through your MyMPERS Secure Member Access account or by completing a paper W-4P and submitting it to MPERS. You can change your taxes anytime throughout the year, as many times as you want. Another consideration is to prepare a budget. Knowing what your monthly expenses are, what they are going out versus the income you have coming in is important. It's important regardless if you're retired or active employed. The last part is to continue asking questions. Our staff is here for your questions regarding your MPERS benefits. In the back of your pre-retirement reference guide, which I remember I'd encourage you to download if you haven't, or use that link on our web that was in that email. There's a list of providers and contact information. If you have questions regarding health insurance, dental, vision insurance, deferred comp, Social Security, cafeteria plan, all of their contact information is listed in that reference guide for your convenience. Additionally, if you would like to make an appointment for a personal counseling session with a benefit specialist, we are more than happy to do so. Our office here in Jefferson City, you can give us a call or send us a message. We can set up a personal counseling session here. We also have the ability to do a virtual counseling session through Microsoft Teams or GoToWebinar. We've got the ability to set all of those up. Or we can answer questions over the phone. And I'm sure a lot of these other benefit providers have very similar availability as well. So we want you to keep in mind all of these pieces of your retirement. When will they be available to you, and how will they change as you progress through retirement? You know, do you have the family plan for medical insurance now? Will you be able to drop, when will you be able to drop the family plan? Will any of that coincide with getting the temporary benefit? Will that help you pay for that family plan insurance? We cannot stress enough to look at a budget. How much money do you spend now and on what? Will those expenses change in retirement? Will they go up or down? What do you want to do when you retire? Do you plan to travel? How will you pay for that? A lot of times we think, well, maybe, we don't need as much money when we retire. Well, all of that's going to depend on the expenses you have and what you want to do in retirement, whether that, how much money you need. So keep all of that in mind. I want to remind you something new that just happened about a week ago. We did implement multi-factor authentication, or MFA, on our website. So next time you log into your MyMPERS Secure Member Access account, you will be required to set it up, and you will need the answers to your challenge security questions in order to do that. Remember, the answers to those questions are case sensitive. You will be able to choose another authentication method to go along with the challenge security questions. This could be receive a code through a text message, or receive a code through your email, or use an authenticator app. You can actually go through and set up all of those now, and then you've got the option to switch back and forth depending on what you might need. If you have never set up an online account, you will have to request a PIN number be mailed to you through the website, or you can call us and we can send that. But that PIN number has to be mailed. So you would click on enroll now, and then there's in that enrollment, there's a request PIN enrollment option there. If you need assistance or have any questions throughout this process or anything, please contact us and we will be glad to help. All right, so I think we're up to the point. Gabrielle, do you have any additional questions you want to share with us, share with the group as we wind down this presentation?
No, we didn't have any other questions come through. Just had some great discussions and prepared some things on the back end for members. So that brings me to the point that if there is something else you want us to take a look at, like your estimate today didn't include backdrop options and you'd like us to take a look at that, you're welcome to send us an email in order to do that, or you're welcome again to generate them on your estimated benefit in your MyMPERS Secure Member Access account. But if there's anything you all need, I mean, we all really enjoy what we do, so don't hesitate to reach out to us. We'd be more than happy to support you. That's all I have.
Excellent. Thank you very much. And thanks for joining us this afternoon. That does also remind me that we do have another email address that you can use to contact us that will go to the group, that benefits team that I showed at the very beginning. You can email benefits@mpers.org and that will go to the group and we'll be able to answer questions for you. So yeah, always reach out to us with any questions. So there is all of our contact information on the screen. For our office located here in Jeff City, phone numbers, website, email address. We are on social media, Facebook, Twitter. We do have a YouTube page as well. Remember the surveys that you will get when you leave the presentation this afternoon, no matter when. If you're not able to take it today, remember it will be included in a follow-up email. So I do thank you for joining me for my presentation. We are not finished with the afternoon. We have 2 more presentations to go. So let's take a quick, probably maybe a 4-minute break, 4 or 5 minute break. I've got 2:48. So let's come back at, we're gonna 2:53. That'll tax my brain a little bit there. 2:53. We're going to go ahead and switch over to the next presenter. The handouts, the slides, any discussion items for the next presenters this afternoon, there are copies of those in the handout section, so you can go ahead and download those on this break as well. So I'm not going to put a clock up because I want to get everything switched over to Rhonda. So let's come back at 2:53. So Rhonda, I'm going to go ahead and switch presenter to you.
Okay.
All right, well, I have 2:53, so let's continue on and keep everything on schedule. As we talked through all the retirement benefits, we talked about there's other pieces to your overall retirement success. And one of those pieces that you hopefully have taken advantage of as a state employee, one of the benefits is the Missouri Deferred Compensation Plan. And we've got Rhonda Peterson here to talk about all of your options with that plan and how it all plays into your retirement. Rhonda, I will let you take it from here.
Okay, Mary, thank you. Good afternoon, everyone. I'm Rhonda Peterson. I'm a financial education professional with the Deferred Comp Plan. I want to thank MPERS for having me here today. We always appreciate the opportunity to meet with our participants and provide information helpful to your upcoming retirement. So I am going to turn off my camera. I just wanted to kind of say hello so you know there's a live body behind this voice. So anyway, let's go ahead and get started with deferred comp. Today we're going to discuss just aspects of the plan that relate to you as you approach your retirement and during those retirement years, including benefits of the plan, the contributions you make to deferred comp. Once you're retired, you want to start accessing your savings, how that occurs, things you need to consider as far as taxes are concerned, penalties, required minimum distributions. We'll get into more detail about all of those. And then just a few action steps to keep in mind as your retirement approaches. But before we get into it, I do want to address the new state match because I know there's a lot of questions out there and a little bit of confusion. Not a lot, but some common questions we're getting. So the state of Missouri will match up to $75. The minimum you have to contribute is $25 per month. So that's $12.50 a paycheck. So if you're contributing $25 a month, your match is going to be $25. If it's $50, your match is going to be $50. If you're contributing $75 or more per month, then your match is going to be $75. So we'll talk a little bit about how your accounts are displayed in your deferred comp plan, but your match goes into your 401 plan. Your contributions go into your 457. So as long as you're making that payroll contribution, it could be pre-tax, it can be Roth, it doesn't matter. Their state is just looking at the amount you're putting in. So if you need to make a change to your contributions, if you do that by the end of the day tomorrow, you can get that started on your August 15th paycheck. And then whatever match you've made for July, you're going to receive that. There's going to be a delay, about 2 to 3 weeks. So any match that you're eligible for in July will actually be deposited into your 401 around the middle of August. Your August will be in September, and so on. So if you need to make a change, you're not sure how to do it, go online. You can do it yourself, or you can call our 800 number and they can do it over the phone for you. Okay, so with that out of the way, but if you have more questions, make sure you ask. So in retirement, what will make up your income? So for most of us that work for the state, we're going to have 3 primary sources. We'll have our defined benefit pension through MPERS. If you see Mosers, we cover them, of course. So just disregard Mosers, focus on MPERS. Your Social Security benefits, as well as your personal retirement savings, which includes your deferred comp plan and additional retirement savings that you may have on a personal level or maybe through another employer. So some advantages and some basics of deferred comp is, of course, it provides you with additional income during your retirement years. When you're making contributions, you have the flexibility to make either pre-tax and or Roth contributions, Those Roth contributions are after-tax contributions. Your funds are professionally managed at a low fee. We're considered one of the lowest cost plans in the nation, which is a big advantage. And then in retirement, your withdrawals are easy, they're flexible, you have tons of options, and there's no additional transaction fees just for you to receive your own money. And then, of course, you still have access to our team of education specialists, both before and after retirement. So take advantage and call us or contact us by email if you need to. So looking at the total cost of the plan, you can see from the chart here, the average fee that our participants pay for both administrative and investment management costs is just 0.24% of assets. That compares very favorably to other government plans and particularly the private sector. So whether you realize it or not, anytime you're investing money, you're paying someone to take care of those funds for you, and your fees should always be a consideration. So with deferred comp, you pay a $1 per month administrative fee plus 0.09% of your assets. That's included in your option or your investment option expense ratio. And what that means is when you look at your account, whether it's online or on your statement, you see your return. The expenses for both administrative and investment fees have already been deducted. So your return is net of those fees. And then you also have your investment management costs, which depends on how you are invested. With your target date funds, you're paying approximately 0.09%, and then the stable income fund is a little bit more expensive at 0.21%. So this chart kind of shows you an example of the impact of those fees on your retirement savings. So we have an investor who starts with a balance of $10,000, is making about a $50 per month contribution, and has an average rate of return of 6% per year. So over the next 25 years, everything being the same except for the expenses, being 0.24, that very low fee compared to the higher fee of 1.39%, that makes over a $25,000 difference in the balance available to this investor. And that's just $25,000 in fees that's going in someone else's pocket. So again, that's why it is important to always consider your fees. So your funds are also available to purchase service with MPERS. Just note that if you have Roth assets in your account, those cannot be rolled over towards the purchase of that service. So I'm sure Mary talked about purchases earlier. So your first contact is with MPERS to determine if you're eligible, to see what that cost is. If you decide it's a worthwhile investment, then you can send us a rollover form, request that money be sent to MPERS. We'll do that within 7 business days. And the big advantage there is there's no taxes, no penalties at the time of the rollover, since it is a qualified retirement plan. Contributions to deferred comp. Let's talk a little bit more about those accounts and how they are organized and what is in where. So you have your 457 account. Some of you may have had a 401 account prior to the state match being approved, but now everyone has a 401. In anticipation, we created the 401 to hold the new state matching funds. So let's go back to our 457. So the money that goes into your 457, you have 2 sources. You have contributory source funds and you have rollover source funds. Your contributory is your payroll contributions that can be either pre-tax and or Roth. The earnings on that money And then at retirement, if you choose to roll into deferred comp any lump sum payment for unused annual leave, then that money will also go into your 457 as contributory source funds. Your 457 also holds rollovers from all other 457 plans. And if you roll over from a 401, a 403, an IRA, this would also include your backdrop. If those rollovers occurred on or after January 1st of 2020, then those rollover funds also go into your 457. So then your 401 holds the employer state match, old state match that was paid out prior to 2010, and then the new state match will go into your 401. And also, if you've rolled over any 401s, 403s, traditional IRAs before January 1st of 2020, those funds went into your 401 account. The rules changed on January 1st of 2020. Now rollovers go into the 457. So that is how your contributions are organized within your different accounts with deferred comp. These are two totally separate accounts. You can invest them differently. You can have different beneficiaries on them. And if you make changes, you have to go into each account and do it separately. One question I get a lot is, can I just combine the two accounts? The answer is no. You'll always have the 457 and the 401 until, of course, you deplete them in retirement. The IRS does limit the amount that you can contribute through payroll deduction. The limits are set annually. They're pretty generous. If you're under the age of 50, your limit for 2022 is $20,500. If you're age 50 or over, there's a catch-up provision where you can contribute up to $27,000. There's also another pre-retirement catch-up provision. If you're within 3 years of normal retirement eligibility with MPERS, or once you get there, there's a one-time 3-year period where you can contribute double the under age 50 amount. So for 2022, that amount is $41,000. So if you're interested in that pre-retirement catch-up, either now or at a point in the future, there is some paperwork that is required. So you can go online to our website, there's information there, or give me a call or shoot me an email, and we can talk about that in more detail. Sometimes the contribution limits will increase from year to year. Sometimes they don't. The IRS usually makes that decision later in the year. So usually mid-November, we know what's happening for the next year. So if you choose to roll in your annual leave so you can defer paying taxes on that amount, again, it will go into your 457 as contributory funds. It will follow that investment allocation that you have on file. If you want to change it, of course, you can do that before the payment is received, or you can always move your funds later. Also keep in mind, for planning purposes, your annual leave is just like contributions you make. So the amount of your payroll contributions plus that annual leave payout for that year you retire must be within those contribution limits that we just looked at. So if you're making a pretty substantial per pay period contribution and your annual leave might put you over that limit, for planning purposes, you might need to make some adjustments there because the two together cannot go over the limit for that year. You can also roll in your backdrop funds. Good news there is no limit on the amount that can be rolled over. That money will also go into your 457 under a rollover. It will follow that investment allocation you have designated for rollovers into your 457. Again, If you need to change that, you can do it before that money is deposited, which is on the last business day of that month in which you retire, or you can always transfer the funds later. That backdrop can also be rolled into other qualified retirement plans, such as a traditional IRA, a 401k, a 403b, or perhaps another 457. But the big advantage of rolling your backdrop funds is the full amount goes into that qualified plan, whether it's deferred comp or another one listed here at the bottom. So you know, defer the taxes and pay taxes on those at a later time. So accessing your savings, once we receive notification that you have ended employment, then you have full access to your funds. We receive that notification from your employer. It can sometimes take up to 2 to 3 weeks after your last day of service. But once we get that notice, we switch your status from an active member to separated from service. That lets us know that you are eligible to start taking money out of the plan. Just keep in mind, anytime you pull money out, you want to make sure that you understand any taxes and possible penalties that apply. Because once you withdraw it, you can't put it back in. You'll just have to deal with those taxes and penalties. So you don't want any unexpected and unpleasant surprises. And upon retirement, if you do not wish to make a withdrawal, there is no action that is required on your part. Unlike MPERS or your healthcare plan where you have some paperwork, applications to complete, there is no paperwork that is required for your deferred comp account, unless of course you want some money. So you have the flexibility in retirement to spend this money however it fits your needs. You're going to decide how and when to make withdrawals. You can pull it all out in a lump sum payment once we receive that termination date. You can periodically just dip into it anytime you want to, withdraw any amount you wish. You can set up reoccurring payments that are made to you monthly, quarterly, semi-annually, or annually. If you do that, those payments can be made any day of the month. You can start or stop them and restart them anytime you want. You can change the frequency, the amount. You can even take additional withdrawals without interruption of those regular payments. Some participants will have a monthly amount directly deposited into their checking account just to kind of offset the cost of maybe healthcare insurance or something like that. You can also choose to receive a check, or we recommend direct deposit. Direct deposit is safer and it's quicker as well. So if you're going to do direct deposit, you can set that up at the time of your first payment request, whether you do it online through your secure account access, or if you're going to request a withdrawal over the phone on our 800 number, you can set up direct deposit at that time as well. So to request a withdrawal, call our 800 number. You'll select option 1. You do have to establish a 4-digit PIN on your account. That's just another security measure to help safeguard your funds. We also recommend that you review a copy of the special tax notice prior to your first withdrawal so you understand any taxes or penalties. And of course, that can all be very confusing. So call us if you have questions or speak to a tax professional. You can also go online to your account access. You'll see a link up here on both your 457 and your 401 plan. So you can select which account you want to pull money from. You'll select withdrawals. Down here at the bottom, you'll select either those regular payments or just a one-time payment. You'll go through a series of a few more screens and set that request up online. But we understand, you know, sometimes it's a little confusing. If the first time you're making a withdrawal, you're not real comfortable, you want some assistance, you know, call on myself or another team member. We can walk you through it, or call the 800 number. And again, they can do it over the phone. Also keep in mind, at the time you request a withdrawal, if you make any change to your indicative data, like a mailing address, that could delay your payment because we're going to verify it's a valid address change before we let any of your money go out of your account. Again, just another safety precaution. So let's talk a little bit about taxes. We'll first cover Roth funds. So your Roth assets, when you take those out, they're tax-free if they are considered qualified withdrawals. So with qualified withdrawals, you have to meet two rules. First of all, the first Roth contribution to your plan must have occurred at least 5 years in the past. So if we look at all these little circles at the bottom, let's say you made your first Roth contribution in 2020. This shows October, but it can be any month. Then you simply count out 5 Januaries, and when you reach that 5th January, in this case, January of 2025, you've met the 5-year rule. So in addition to the 5-year rule, you must also be at least age 59 and a half. So if you meet both rules, pull your Roth assets out, you have no further taxes on the distribution. You've already paid taxes on the contributions. That means all the earnings on those Roth contributions would be totally tax-free income. That's the biggest advantage of your Roth contributions. In addition to the 5-year rule and the age 59 and a half, there can be some exceptions if you become disabled or your death occurs and payment is made to a beneficiary. So again, if you meet both rules, 59 and a half, 5-year rule, no taxes. Well, what if you don't meet both rules? Well, you've already paid taxes on the contributions, so you're not going to be taxed on those funds again, but you will be taxed on any earnings. So anytime you take a withdrawal of your Roth funds, there's always going to be a prorated amount of contributions and earnings. So part of that distribution will be taxable income if you don't meet both rules. If you have pre-tax assets, you have not paid taxes on any of the money, so the entire withdrawal is considered taxable income. The IRS requires an immediate 20% withholding on your taxable income. So if you would request $1,000, that means your 20% withholding is going to be $200. You're going to get $800. We're sending $200 to the federal government. The funds are also taxable at the state level, but the state of Missouri does not require that immediate withholding, but if you want us to withhold, we will. You just need to let us know. And then anytime that you take a withdrawal, whether it's Roth or pre-tax or maybe both, that following January, we're going to send you a 1099-R form. This process works just like a W-2. Your funds in deferred comp are taxed as ordinary income, so that form is going to show you the total amount you withdrew for that year, whether the funds are taxable or non-taxable. It will also show you the amount of taxes that you've already paid. And then you're going to use that form to file your income tax for the year. And it's kind of like working. If you paid in too much, you get a refund. If you haven't paid in enough, you're writing a check to the government. Okay. Let's go back to the second bullet. So with this 20% mandatory federal tax withholding, there are a few exceptions to that rule. direct rollovers to another IRA, 403B, 401. There are never taxes or penalties with those qualified rollovers. Unforeseen emergencies, those actually occur while you're still working. So under IRS guidelines, if you qualify for an unforeseen emergency, maybe you get sick or have an accident and you have some medical bills you need to pay, you can pull money out of your deferred comp while still employed, and then you have some discretion with that 20% federal tax withholding. It's still going to be taxed. It's just they don't require the immediate withholding. Required minimum distributions, those begin at age 72 if you're no longer working. We're going to talk about those in a little bit more detail. And then regular payments that exceed 10 years. That could also be an exception to that 20% mandatory federal withholding. Okay, another fun topic, penalties. So some of your money in deferred comp is never subject to penalty. Some of it can be penalized. So the money that is always penalty free will be housed in your 457. It's the contributory funds. So that would be your payroll contributions, the earnings on that money, your annual leave payout that you've rolled in at retirement, that's always penalty free. And then only your rollovers from other 457 plans. That money you can withdraw at any age and not have to worry about a penalty. You might have to pay taxes, but you do not have to pay a 10% early withdrawal penalty on that money. Your other money, which includes your employer state match, all other rollovers other than the 457, from 401s, including your backdrop, 403s, IRAs, the penalty applies. And again, it's a 10% penalty if you receive the money before age 59 and a half. And that penalty is on top of taxes. So there are some exceptions to the penalty. The first bullet is typically the big one. If you end your employment with the state during or after the calendar year that you reach age 55, that penalty goes away. If you're considered a public safety officer rather than age 55, your age is 50. So if you're going to end employment, and it's not your retirement date, it's your employment end date, last day of service. So if you end employment by December 31st of 2022, this year, and you're turning age 55 or 50 if you're a public safety officer by December 31st of this year, you don't have to worry about penalty. However, if you're ending employment this year, you're turning 54 or less, or again, public safety officers, you're a little different, then that penalty will apply if you pull your money out before age 59 and a half. Okay. Another exception would be payments that qualify as substantially equal payments for a period of time, and also in the event of a disability or a death. Okay. So again, if you have any questions about taxes or penalties, make sure you understand it before you request that withdrawal, because after the fact, it's too late. And again, you don't want that unexpected surprise. So let us know or talk to your tax advisor. So I mentioned required minimum distributions. This is an IRS rule. It's pretty global to really all retirement plans except your Roth IRAs. If you're not working, the year you turn 72, you have to start taking a minimum amount out of your deferred comp account every year. So your RMD must be taken by December 31st of each year. However, that first RMD, the year you turn 72, you can actually delay that one until April 1 of the following year. However, if you delay it to the following year, that means you have to take 2 for that year. The one you delayed plus the one that is required for that year. One question I get a lot is, well, can I just roll my RMD over? Good try, but unfortunately the answer is no. The whole purpose of RMDs is for you to take your money out so you'll pay taxes on it. The purpose of those rollovers is to continue to tax defer the money. So when you take your RMD, you can put it in a savings account. You don't have to spend it, but you will have to pay taxes on it. And of course, they make the penalty very severe, so you'll want to take it out. If you don't take your RMD, the penalty alone is 50%. So if your RMD is $1,000, that means your penalty is $500 in addition to taxes on the full $1,000. So most of your money is going to go to the government. So this is what's going to happen with your RMD. That year that you turn 72, if you're not working, we're going to send you a letter at the beginning of the year to let you know you have to take an RMD this year. This is the amount you need to take. And if you don't take it by the very latest deadline, again, April 1 for the first one, December 31st for all subsequent ones, we're going to automatically send you the amount that gets you to that minimum RMD, so you won't have to pay this ridiculous penalty. Okay, so deferred comp has your back when it comes to those RMDs. And this is how your RMD is calculated. You basically take your balance as of the end of the previous year, then you take your age and look at that distribution period. You simply divide that factor into your balance. So in this case, our balance is 50,000. The age is 72, so the distribution is 27.4. If you do the math, the RMD amount is approximately $1,825. Quickly, it's about 3 to 4% of your account balance. There is an RMD calculator on our website. So if you visit it, you can not only see the RMD for a specific year, you can assume an ongoing annual average rate of interest, and it will give you RMDs down the road too, into the future. And then of course, you also have the option to roll your deferred comp money out into another qualified plan. The exception there is any money that you've rolled into the plan while you were working, you can roll that money out even before you end employment. But if it goes to a tax qualified plan, traditional IRA, 401s, 403s, 457s, then there's no taxes, no penalties at the time of rollover. So you can do that process through filling out a form or contacting our office, and we'll walk you through it. There are some considerations you will want to keep in mind, and there are some advantages of keeping your money in deferred comp. You don't want to lose penalty-free access to your savings before age 59 and a half. So for example, let's say your money's sitting in your 457, you're less than age 59 and a half. If you need to take a withdrawal, you don't have to worry about the penalties. However, if you take that money, you roll it into maybe a traditional IRA, well, now it's traditional IRA money, and no matter what, the 10% penalty applies to all withdrawals before age 59 and a half. So if you would have left it with deferred comp, pulled it out, no penalty. Now it's sitting in an IRA, you're not yet 59 and a half, you need to pull it out, you're paying 10%. So keep that penalty-free access advantage in mind, as well as your fees. That's always a big one. There is a document on our website, so if you're considering rolling money out, you might just want to review that, some considerations to keep in mind, some questions to ask. If you can't find that on our website, again, let us know. We'll make sure you get to it, or we'll send it to you. And then just a few action steps to keep in mind. Tons of information, of course, on deferredcomp.org, newsletters, videos. There's some very helpful calculators. The retirement withdrawal calculator will help you manage your money in retirement. A couple of different approaches you can take with it. You can plug your balance in and tell the calculator, if I withdraw maybe $500 a month, assuming a set rate of interest going forward, how long is my money going to last? Or if you want your money to last maybe 25, 30 years in retirement, it will tell you how much you can pull out on an annual basis. So that can be a handy tool to help you manage your funds long term. We've already talked about the required minimum distribution calculator out there. The retirement track calculator, you can use it before and after retirement, and it pulls in all sources of income. So it's a very comprehensive tool that will look at your overall financial picture. And then if you still have a few years to go, you're trying to project what your deferred comp account might look like at retirement, then use the Grow Your Retirement Savings tool. All those calculators are pretty intuitive. They're pretty easy to use, but if you have any questions, again, let us know. There's also some financial planning services available with our record keeper, which is Mission Square. So if you're looking for some just general information, non-biased opinions, these are certified financial planners who are on staff just to help members with their retirement planning. They don't work on commission, so no matter what decisions you make, they're not going to benefit by it. So they don't really have a dog in the fight there. They're just there to help you make good decisions about your future. So with that financial planning, there's a cost involved. However, you can get one tier done for free if you have a balance of at least $100,000. The other tier is a very comprehensive financial plan. If you and if your spouse is also part of deferred comp and your combined balance is at least $200,000, you can get that for free. Otherwise, there's a charge, but again, it could be a good resource to just get some non-biased information and direction. And then, of course, before your last day of service with the state, make sure you update your contact information online. A lot of us use our email addresses, our phone numbers at work. Well, you're not going to be there anymore, so you're not going to have access to that. And you're going to need it if you want to get into your account, because currently we send you a security code. We either email it or text it, and if you don't have the right information on your account, it can be very frustrating to try to get information if you go online. So just make sure you update that before you leave. And then also keep your beneficiaries up to date. Again, both your 457 and your 401 account should have primary and contingent beneficiaries. So if you had a 401 previously, you probably named your beneficiary. If we created one for you here in the last month or so because of the match, we just copied over your 457 beneficiaries. If that's okay with you, leave it. If not, you might want to go in and change them. One rule, if you're married, your spouse must be named as your primary beneficiary. If for whatever reason you don't want your spouse to receive your funds, then he or she does have to sign off on a consent form, and it must be on file for you to have another valid beneficiary. If we don't have that form on file and we see your spouse is not named as your beneficiary, your spouse could still be legally your beneficiary. So again, tons of ways to change your beneficiaries. Call the 800 number You can go online, you can call your field reps, we can change it for you. There's also a beneficiary form on our website. If you have questions, let us know. And then if you need further information, this is an image of our website. Under event registration, which is on the home page, you'll see a long list of opportunities for webinars. The webinars are geared to different career stages. They're also geared to different topics. So you might want to just review that, sign up for anything that you might be interested in. Also, if you want to do a virtual one-on-one with myself or your field rep, you can see that calendar out there as well. These are our field reps. I'm in the Southwest District. You can call your own in your district or call any one of us. We're not gonna not talk to you just because you're not living in the territory we cover. So call any one of us. We're always happy to help. Also, account access. You can log into Deferred Comp, set up your username and password. I don't think MPERS, you all have access to the ESS portal, but if you do, that's another way you can get in. Excuse me a second. You can follow us on social media. If you like to do business on your smartphone, you can download our mobile app that is available through iTunes or Google Play. So go to that mobile app, just search for Deferred Comp, and then you can download that app and have access to your account. It's a little bit more limited than if you have your computer, but you can see what your account balance is. You can go in and make changes. So check it out. It can be a handy tool for you as well, particularly if you're not sitting in front of a computer all day. You can also sign up for text access and mobile alerts where you can receive account information or just general deferred comp news and updates. And then this is my contact information. So if I can be of assistance, feel free to reach out to me by either email or give me a phone call. If you get my voicemail, leave a message. I will call you back just as soon as possible. So that pretty much does it for me. I don't know if I have questions or if I can even see those. Let me check real quick and we'll see what's going on here.
Yeah, they're in the questions section, Rhonda, but I think you may have answered it, but I'll let you check that. I will mention, you mentioned whether we were in the ESS portal, and MPERS is not in the ESS portal. Our website is completely separate from any of that.
That's what I thought. So,
yep.
All right. So I'm checking over these questions. Okay, so Angela, am I able to change risk options since you're close to retirement? Yes, you can change your asset allocation at any time. And if you retire, select the backdrop. You can transfer that to deferred comp, yes. And you can do all or any part of it. And then you pay taxes on that backdrop money when you actually pull it out of deferred comp. And again, the penalties could apply. It's all about if you terminate before 55 and whether you're 59 and a half. Okay. I think that was it. Did you see anything else, Mary, that I'm not seeing?
I did not. I think that covered everything.
Okay, all right. So again, if y'all have questions, just reach out. We're more than happy to help. We want to make sure that you understand what you're doing before you do it. So let us know. Thanks, Mary, for having me. Thanks, everyone, for your attention. Have a great rest of the afternoon.
Excellent. Thanks, Rhonda. As always, it was great hearing from you and sharing that good information. So let me get the presentation switched over. So again, we talked earlier about, all the different benefits that you have as a state employee. And, there's a lot of different benefit providers. So we've talked about your retirement with MPERS. We've talked about the benefits and options you have with the deferred comp. Another important piece of that whole retirement success is your insurance benefits. And there's a lot of different ones and a lot of different pieces to those. So we're glad to have Jill Cleathermos with us this afternoon to kind of help us through navigate all of that, all of those other benefits pieces. So Jill, I will let you take it.
All right, thanks, Mary. Do you see my screen okay there, Mary?
Yes, yes, great.
Okay, fantastic. Well, welcome everybody. Yes, I'm Jill Cleathermos. Thank you, Mary, for that introduction. I'm going to address today how your benefits will be impacted once you choose to retire. Brooke Lukey is going to attend with me here, and she will address any of your questions that you may have throughout this presentation. So if you have questions that need to be shared, she will address those at the end of the presentation if we still have time to do that. If not, we will email you directly. So to begin, some of the things I want to touch base on is how is your medical insurance going to be impacted? How is your prescription coverage going to be impacted? What about your dental and vision insurance, your cafeteria plan, plus various different insurance policies that you may have for MoDOT and the Highway Patrol members? I will be addressing all of these areas in full detail in hopes that you will have a clear understanding of how you can transition into retirement while maintaining the benefits you wish to take with you. So first here, I want to share information regarding your medical and prescription policy. Your medical and prescription benefits will all remain the same as you retire. So this means you'll have the same level of coverage as you do now as an active employee regarding your annual deductibles, your out-of-pocket maximums, as well as your copays. You also have the same coverage services, and you will also have the same in-network doctors. Now, however, when you reach Medicare age, you will encounter benefit changes. So in order to be eligible for medical and prescription coverage as a retiree, you must be enrolled on the medical insurance policy while you are an active employee prior to your retirement date in order to carry this coverage into retirement. So once you retire, you must stay enrolled on the medical plan in order to continue this coverage. If you choose to cancel this policy, whether it be at the time of your retirement or you will not be able to come back on the medical plan, for this decision is a permanent decision. So there is one exception I want to touch base on. Those who have active military coverage when retiring from MoDOT or from patrol. Once your military service ends, then and only then can you reinstate your medical insurance with us as a retiree. You will need to notify us prior to your military discharge to get re-enrolled, and you will have 60 days from separation from military to complete this process. As far as your coverage for your dependents must be enrolled on your medical plan prior to your retirement, or they can have what's called a qualifying event, and they can be added to your retiree medical plan. So yes, qualifying events still apply as long as you, the active member, is enrolled on the medical plan. So if your dependent is, if you're experiencing marriage, or you need to add a dependent because of adoption or birth, or your spouse may have a total loss of coverage, or spouse total loss of employer contribution toward their medical premium. These are all qualifying events that will allow you to add your dependent. This is time sensitive. You will need to be in contact with your insurance rep as soon as possible, for there is only a 31-day window to make this election to add your dependents. But if your dependents are experiencing a total loss of coverage, you will have 60 days to make this election. But be in contact with your insurance rep as soon as this happens, because there is documentation that they will need to give you some advice on acquiring. So don't wait to the last minute for that. If you are not currently enrolled for medical coverage as an active employee, and you wish to have the MoDOT and Patrol medical plan as a retiree, or you wish to have a dependent listed under your medical plan going into retirement, I recommend that you plan this ahead. You need to make this election at the next open enrollment period prior to your retirement date, especially if your dependent is not going to experience a qualifying event. Medical coverage open enrollment for active employees is held only in the month of October every other odd number of years. So our next open enrollment is going to be October of 2023. Then it will happen again in October 2025. So keep in mind, you cannot enroll for medical coverage, nor can you add a dependent to your coverage at the time of your retirement. The only changes that you can make at the time that you're filling out your retirement papers is you can drop a dependent at that time, or you can cancel your medical coverage altogether. I do recommend that you plan this ahead, looking at your medical benefits, what you have now as an active employee. You really need to ask yourself, is this what I need to go into retirement? Some of the decisions have a lifelong impact on your coverage. So talk to your insurance reps, call our benefits office, let us be the ones to help you make these correct decisions and be best prepared. What does my family need to do in the event of my death to continue having medical coverage under my policy? Well, they must be enrolled on your medical policy prior to your death. So at this time, if your dependents wish to continue being enrolled on your medical policy and keep this medical plan, they can do so as a survivor, and their benefits will all remain the same. So to make this happen, your survivors, your dependents, would first need to notify MPERS of your death. MPERS will notify the benefit department, and your dependents will be automatically set up to continue coverage unless they state otherwise. So your dependents would need to continue paying the monthly medical premium through your retirement pension, or they can set up manual payments. And this all depends on each individual situation, and our department will work with them to help figure this out. Plus, they must meet the eligible requirements, meaning that your children can only be covered up to the age of 26. For those who terminate employment as a vested member prior to retirement eligibility, you can still receive medical insurance benefit at the time you reach retirement status. In order for this to happen, you must be actively enrolled on the medical plan prior to your termination of employment. You must elect vested coverage on the medical plan at the time you terminate employment. You must continue having this coverage, and you must keep paying 100% of this monthly premium until you reach your retirement status. Then you must also carry this policy with no lapse of coverage during your vested years. If you do all that, when you are eligible to retire, you will need to contact your insurance rep, who in turn will help change your coverage from vested to a retiree category. They will recalculate what your new monthly premium rate will be, because at this time you'll be adding the employer contribution towards your premium. This calculation is based on your total numbers of years of service that you completed with the department. Then you will need to continue making your monthly payments either through the retirement pension or manual payments, which can be done by check or auto bank draft. Once you complete this process, you will be carrying the medical insurance as a retiree with the employer contribution added. In the event you become disabled prior to retirement, you can continue your medical coverage with the same level of benefits. The difference, the premium cost. The premium rate for those who are approved for long-term disability, your monthly premium rate is going to be based on a retiree rate. For members who are approved for work-related disability, your monthly premium rate is going to be based on an active employee rate. If you become approved for Social Security disability, you may be eligible for early Medicare benefits. In the event that you're approved for early Medicare, I highly encourage you to enroll only in Medicare Part A and Part B as a boy when you are first eligible to prevent any penalties. It will be your responsibility to notify our benefit office here at MoDOT or the patrol when Medicare will be active for you. Plus, we will ask that you send a copy of your Medicare card. At this point, we will then enroll you to a Medicare supplemental medical plan, and your monthly medical premium will change to a retiree Medicare rate and based on your years of service. So keep in mind, when you are approved for disability, we will need to set up manual payment options for you to pay your monthly medical premium. This can be done either manual monthly payments by way of check or auto bank draft. We recommend setting up an auto bank draft, for this is the easiest and most insured way that payment is received on time and helps eliminate a chance of you losing your coverage due to delay in payment. Your medical premium rate will increase as a retiree. How much increase depends on your total number of years of service with the department that you complete at the time of your retirement. When preparing for retirement, I recommend that you take time to calculate what this increase will look like for you and how it will impact your overall expenses or your retirement budget. So as of January 1st, 2015, we started basing your retiree rates off of your total years of service. So to calculate how much your employer pays toward your premiums, we will look the total number of completed service years to the department. We'll multiply that by 2, and this amount is what your employer contribution rate will be, with 50% being the maximum the department will pay toward your medical premium. So keep in mind, backdrop plays no impact on your total years of service premium calculation. If you wish to explore this calculation prior to retirement election, I highly encourage you to check out our premium calculator on our employees benefit website. This is a great tool to aid in figuring out what your monthly premium rate will look like according to your specifics, whether that is PPO or high deductible health plan, and then look as well as the number of years of service and what number of dependents you wish to have on your medical plan. If you prefer, you can also call your local insurance rep or one of us benefit specialists, and we will be happy to help you as well to help figure that out. An example here for a non-Medicare retiree. Say you retire with 22 years and 4 months of service. In order to calculate your monthly premium, we will use 22 years, so there's no rounding up. We'll take 22 years, multiply it by the 2%, and resulting in an employer contribution of 44% and you paying 56% of your monthly premium. So for a non-Medicare subscriber with under the PPO plan, you will take the total base premium amount of that $667. Next, multiply that by 44%. MoDOT will be paying $293.48 and leaving you at $373.52 as your monthly cost. So no matter what your premium category you fall into, you will always use the base premium amount to help calculate what your monthly premium will be as a retiree. If you are enrolled in a high deductible health plan, we still calculate it the same. The only thing you'll see different based on the premium rate for this plan has a lower premium in comparison to the PPO plan. So looking at this one, the base premium is $605 plus the 22 years, meaning that the department is going to pay 44% of you. So MoDOT will be paying $266.20, and then you would pay $338.80. So look at what category you fall into, use that base rate, and then times it by your total years of service. For those who are enrolled in the high deductible health plan, you can remain on the high deductible health plan as a retiree until you or a member of your plan, one of your dependents, become Medicare eligible. So once this happens, Medicare does not allow you to be enrolled in a high deductible health plan with the HSA to avoid certain IRS tax implications. We recommend that you be proactive, change your high deductible health plan to the PPO plan during October of the prior year that you are going to be turning Medicare eligible. In order to have this effective January 1st of the year you or your dependent turn 65 and become Medicare eligible. So mark that on your calendar, that October, October that you're age 64, mark it on your calendar that you need to roll over to the PPO plan and have that ready to go for January. So remember, most important, you cannot make this election change at the time you retire. So you need to plan accordingly. For those who are non-Medicare retirees, you are able to change your election from PPO to high deductible health plan, or those who are a high deductible health plan to the PPO every year during the month of October. So October 1st to October 31st, you can make this election change. That change will then become effective January 1st, just like any active employee can do. You just, once you reach Medicare coverage level, you have to stay under the PPO plan from then on. So if you are under the high deductible health plan, you can continue making contribution to your HSA pre-tax from your monthly pension check as well. However, you will no longer receive the employer contribution towards your health savings account once you retire. So therefore, you'll be the sole contributor to that account. When you turn 65, you do become Medicare eligible, like I just mentioned. At this time, Medicare will become your primary coverage. Your current medical plan with MoDOT and Patrol will become your supplement plan and will pay secondary to all your medical services. Your MoDOT and Patrol prescription coverage converts to a qualifying Medicare Part D prescription plan. So with this in mind, you only need to elect Medicare Part A and Part B when you make that election. Once you receive Medicare card, we ask you to send a copy to the benefits office. Once your benefit department receives your Medicare card showing the effective date of Medicare Part A and Part B as a boy, the effective date needs to be the first of the month that you turn 65. Once we receive that Medicare card, then your insurance will be changed over to the Medicare benefit. There is an exception to enrolling in Medicare Part B as a boy. For any of our retirees, if you are still active, any member who is still actively employed, or any of our members who are covered under your spouse's employer-sponsored medical plan while they are actively employed, and you become Medicare eligible, then you will need to elect only Medicare Part A coverage and then waive Medicare Part B, which is the part that has a monthly premium cost. Then, at the time when you or your spouse is ready to retire, that is when you will want to start the process in enrolling Medicare Part B coverage. I highly recommend starting this process at least 3 months prior to your retirement date. So if you are actively working and you're going to be turning 65, 3 months before you turn 65, get that enrollment going for Medicare Part A. 3 months before you get ready to retire, you need to contact Social Security again and get the process going for Medicare Part B as in boy so it can be ready to go for you. Medicare Part B coverage must be effective the date of your retirement or the date that you turn 65. So once you become Medicare eligible, your monthly medical premium will decrease to the Medicare base rate according to your elected category. I also want to note your monthly premium amounts will be able to be deducted from your monthly pension check. So we will send a file over monthly to MPERS to inform them of your premium deduction. As I mentioned earlier, our prescription drug coverage will automatically transition into a qualifying Medicare Part D prescription drug plan once you are enrolled on Medicare. So Medicare prohibits members from having two Part D, D as in David, and Part D plans. That's the prescription part of it. Therefore, you cannot be enrolled in two Part D prescription plan drugs. If you are, Medicare will notify us, and if you become dual enrolled, we will be forced to cancel your supplemental coverage with MoDOT and with the medical plan. If we are notified, we will work with you to make sure that this is a true intent that you have. If you wish to keep your coverage as your supplement to Medicare, it is very important to enroll. It is very important not to enroll in any other Part D policies outside the MoDOT and Patrol plan. We do understand that this can be very confusing. So if you are looking at another medical plan, I do recommend that you contact the benefits department first before making this decision. Also, Medicare has an annual prescription deductible of $100 that applies immediately the first of the month that becomes effective. This deductible repeats every calendar year in January. So even if you've already met your prescription deductible prior to turning 65 for that year, you will have another deductible to be met. Also, if there's a generic drug available for the drug you take, you do get penalized for taking the name brand over the generic. So with Medicare prescription plan, you will get charged 50% coinsurance on all brand name drug prescriptions after you've met your deductible. Now I want to shift gears into the dental and the vision coverage. Dental and vision is administered by Missouri Consolidated Healthcare Plan. So in order to have dental and or vision insurance at the time you retire, you must be enrolled on this prior to your retirement date, and you must be receiving a retirement benefit from MPERS. In order for your dependents to have dental and vision coverage after you die, your dependents must be actively enrolled on that policy prior to your death. Your dependents can continue their coverage as a survivor. In order to do that, they will need to continue meeting eligible guidelines. Against like your dependents for your children, they have to be under the age of 26. Your surviving dependents must submit a survivor enrollment form within 31 days of your death to Missouri Consolidated Healthcare, and your surviving dependent is required to pay that monthly premium. Your dental insurance premium will remain the same when you retire. So looking at this chart, find what category applies to you at the time of your retirement. Whether it's an employee only, employee spouse, employee family, look at what your category is. This rate here is listed as a full month premium. The vision plan still offers two choices for retirees. You will have the choice to stay under the basic or the premium. Both plans have a slight increase from an active employee rate to the retiree premium rate. So looking here at the category and see what applies to you, drop down to that retiree rate and see what your small increase will look like at your retirement. Now let's address the cafeteria plan and the different scenarios in which you can participate to receive tax savings through the year in which you retire. So some people think they should not participate in the cafeteria plan because they think it will reduce their pension benefits. The truth is participating in the cafeteria plan has no impact on your pension benefits. In fact, higher your tax bracket that you fall in, the more money you'll be able to save by participating in the cafeteria plan through the end of the year in which you retire. I will address the different tax saving options that are available to you, like the premium only category, the healthcare flexible spending account. You can participate through the end of the plan year in which you receive your last active paycheck, and it's very important to plan ahead in order to take this advantage of the savings. One way you can take advantage of this tax savings is by prepaying your retiree insurance premium through the end of the plan calendar year in which you retire. This means that you can prepay your medical, you can prepay your dental, you can prepay your vision monthly premiums pre-tax by participating in that premium only cafeteria plan. This does require you to plan ahead and have those premiums taken out of your last few paychecks that you will be receiving. So by doing this, you will have at least about a 20% savings in taxes by pre-funding that. And that is something you would want to talk to your insurance rep to help you with. Here's an example of how this would lay out. So let's say you retired July 1st with 25 years of service and you have the medical insurance plan and you're enrolled as a non-Medicare subscriber. Your monthly premium is going to be $333.50. When you retire July 1st, you can elect to pre-fund this amount for 6 months, which takes you till the end of the calendar year, which is January of the following year. Because remember, medical premiums paid the month before. So by December, you are paying for January. So therefore, you can pre-fund even your January account. To calculate the non-Medicare subscriber with 25 years of service, we will take that $333.50. We'll times it by 6 months. That gives you a $2,001 as a total amount that you can pre-fund pre-tax. By preparing, this gives you a potential 20% savings, resulting in a $400 savings that you can be able to pocket. You can prepay your medical premiums. You can also prepay your dental premiums. You can prepay your vision premiums for the remainder of the year in which you retire. The more you pre-fund, the larger tax savings you will have. Another way of tax savings is by participating in the healthcare flexible spending account. For those who participate in the cafeteria healthcare flexible spending account as an active employee, your participation ends on the date in which you retire. The funds remaining in this account must be incurred cost before your retirement date in order to have that money reimbursed to you. In other words, it's very important that you have all these services before the date you retire. You do have the option, though, to continue your flexible spending account through the remainder of the calendar year in which you retire, which would aid you in additional tax savings that I want to share with you. So this is done by pre-funding your healthcare cafeteria healthcare flexible spending through the end of the year in which you retire out of your annual leave paycheck. If you have set medical expenses each month and you want to consider taking your annual leave payout amount and pre-fund this cafeteria flexible spending account to continue with your claim expenses that you may still incur until that December 31st of that calendar year that you retire, this will give you additional tax savings from your paycheck while funding this medical expense. So if you elect this option, your flexible spending account will not stop on the date that you retire. Instead, you'll have until December 31st to incur that cost plus the grace period to use that money, resulting in another 20% savings of taxes for your anticipated medical expenses or prescription expenses. Remember, if you wish not to pre-fund your flexible spending, then you must incur expenses prior to your retirement date that totals your account balance. One way to have a tax savings is to pre-fund your flexible spending by your annual leave paycheck that I just mentioned, out of what's known as your unused vacation time, plus your unused comp time, as well as your, for any of your federal comp or your state comp time and annual leave that you may still have in the books at the time of your retirement. So that annual leave, this will give you a lump sum payout for that annual leave and comp time that you have on the book. And this annual leave will be directly deposited into your account the last of the month in which you retire. But with this lump sum payout, you can elect to pre-fund your medical, you can pre-fund your dental, you can pre-fund your vision premiums, you can also pre-fund your cafeteria flexible spending account. This can be all different ways that you can fund that and have a tax savings for that annual leave payout that you would have. How much you can pre-fund all depends on how much your annual leave payout calculates to. Also, if you plan to retire January 1st, then pre-funding your cafeteria flexible spending is not an option because it requires you to have at least one paycheck, 1 month of funding into that account. So then that would ask you to consider retirement then February 1st and not January 1st. So keep in mind, though, there is a max number of hours depending on your completed years of service. So if you plan to retire and you have 12 years of service and you have 300 hours of annual leave on the book, we can only pay out 288 hours of annual leave. Now, for those that retire with more than 15 or more years of service, the maximum payout hours that we can pay you out on is 336 hours. So if you are seeing that you have more than that, you will need to look at how much time do I need to be taking off to utilize, or do I want to donate those hours? If you have any questions regarding the cafeteria plan or how you can take advantage of tax savings, I do recommend contacting your insurance rep, or feel free to call our benefits office. It's 863-9406 and speak to one of us here, the benefit specialist. We are happy to walk you through any of your options and help address any of your concerns. I do recommend highly outreaching to your insurance reps as soon as you are even considering retirement, because the sooner you can talk to your rep, the sooner the rep will be able to help you regarding what benefits you wish to elect, help you to get better prepared for it, and make those elections. This also gives time for your insurance rep will need time to prepare your forms, and your rep will want to set a date to meet and go over your benefits and retirement. And it's going to be important to have this all done in order to meet payroll deadlines. So the sooner you can think about it, my recommendation is try to give your insurance reps at least 2 months notice before retirement. And that way we can have enough time to get things set up, ready to go and send to payroll to make that all work for you. Now, as far as deferred comp benefits, you have the choice to deposit part of your lump sum annually payout that I just was talking about pre-tax, and you can transfer money into your deferred comp. If you opt not to fund any of your premiums, you can fund deferred comp, or you can do all of it. So just depending on what your lump sum payout would look like. When you invest in your lump sum annually payout to pre-fund your premiums, pre-fund your flexible spending account, and transfer to your deferred comp, these are all great ways to help lower your tax amount on that payout. But one thing I do want to point out, regardless of how much you pre-fund or how much you transfer to deferred comp, we do need to, or you will be required to pay some taxes on that annual leave payout. Also, we make sure we leave around $150 to $200 as a payout for you, and that will be automatically deposited direct into your account the last day of the month that you retire. This is a small amount that will act as a cushion in case anything comes up before your retirement date and that you end up taking additional time off. So leaving that on there helps ensure that you have enough there to contribute to your cafeteria plan or to fund any of your deferred comp, any of your pre-funding that you have elected to do. The last section I want to go over pertains to life insurance and what you can take with you into retirement. There are several different life insurance policies available. So we have the state paid, also known as a basic life. We have the optional life. We have voluntary life. We have BMA and MetLife. We have Trustmark, Allstate, and there's also a cancer policy called Central United. So let's first look at the state paid, the basic life insurance. This policy is funded 100% by your employer. So this policy is equal to one time your annual salary while you're actively employed. So this coverage will terminate the end of the last month you work, therefore no longer effective once you retire. If you wish to continue this policy, you can apply for portability or conversion. If you're interested in making this decision, you will need to make direct contact with Minnesota Life and Securian within 31 days of your termination of coverage. So you can contact your insurance rep, and your insurance rep can give you that phone number to make that happen. Optional life insurance benefits deferred depending if you retire under the closed plan or under the year 2000 or 2011 plan. The difference depends on how much coverage you can take into retirement. So for those who retire under the closed plan, if you are currently invested in optional life as an active employee, the maximum amount of coverage that you can take into retirement is going to be a $60,000 policy. Now, if you carry a small amount policy and it's less than $60,000 and you wish to increase your optional life purchase amount at the time of your retirement to get to that, reach that $60,000 policy, what we can do is take part of your state paid life insurance, add it to the amount that you have already with optional life to help equal that $60,000. Now, if you have optional life, that's a $15,000 policy, and you make less than $45,000, then we won't be able to reach that full $60,000, but we can help join the two together. Now, if you are not currently enrolled in optional life coverage as an active employee and you wish to have this policy at retirement, you can take your state paid life insurance and convert it to an optional life policy with the maximum limit of the $60,000. So if you make a $35,000 state paid life insurance policy, you can elect to roll that $35,000 to an optional life policy. So in order to have this available to you, must retire with active employment. If this is of interest to you, your insurance rep or your benefit specialist can help you roll your state paid into optional life at the time of retirement. You will just need to make that communication with your rep. For those who retire under the year 2000 or the 2011 tier, for those members who are currently invested in optional life as an active employee, you can retain your current optional life coverage into retirement. So this means that you can carry the maximum of 6 times your annual salary, and you can take that policy into retirement. If your optional life purchase amount is greater than $60,000 at the time that you turn age 62, you will your policy then will reduce down to $60,000 once you reach 62. If you do not carry optional life as an active employee and you wish to take this policy into retirement, this will require you to make this enrollment 4 months prior to your retirement, if not sooner than that. To make this election, you will need to contact your insurance representative or contact us at the benefit department. We will be happy to send you the enrollment form to make this possible. Now keep in mind, once this form is completed, we will submit it to the company. The company will then send you a personal health assessment form to complete. You will be required to send that back to them. And once they receive that, the company Securian will have the option to approve or deny that health assessment. But that is one way that you could apply for optional life, but it does take a little bit of planning out and needs to be proactive and start that process at least 4 months before your retirement. Regardless of which plan you elect to retire under, here are a few things to keep in mind with optional life insurance. First, once you terminate your policy, you are not able to re-enroll. Another, you cannot increase your purchase amount after you retire. You do have the option to decrease your purchase amount at any time during retirement, and you can do that multiple times. As a retiree, your optional life premium rate will increase at the time of retirement because you will move from an active rate category to a retiree rate category. Also, your monthly payment will automatically deduct directly from your monthly pension check from MPERS due to the fact that this is a MoDOT and Patrol sponsored plan. For those who purchase dependent child life coverage with optional life, this policy will terminate upon your retirement. For those that have the spouse coverage for has purchased a spouse policy, this policy may continue when you retire. The spouse purchase amount cannot exceed the amount that you hold for yourself, and at the time of your death, the spouse will convert to optional life policy into an individual policy if the application is made within 31 days from your death. Otherwise, the spouse policy will terminate. So this is something that you will want your spouse to be aware of, and contact your insurance rep or call our benefits department within 31 days of your passing if your spouse is interested in making that conversion. MoDOT employees who carry the voluntary life insurance, when you retire, this policy is administered by Arch Brokerage. You can retain, no matter what your purchase amount is right now as an active, when you go to retire, you can only retain $2,000, $5,000, or $10,000 coverage amount. With this policy, you cannot terminate and later re-enroll. And for your spouse and dependent coverage, that coverage will terminate if you carry that coverage for them while you're active. That will terminate when you retire. So to continue this coverage, you will be required to have manual payment directly to the company. If you have this policy, your insurance rep will help you in completing the step and taking this policy into retirement or making the election to cancel this policy. Your rep will also aid you in completing the bank draft form for your monthly payments to March Brokerage will be successful transition for you from an active to retiree. Patrol employees who carry the BMA and MetLife insurance, when you retire, this policy has a max purchase amount of $50,000 for retirees. Once you turn age 70, the purchase amount will decrease to a $25,000 policy. If you invested in the spouse and dependent child coverage, these plans will continue when you retire. So to continue your coverage, this will require manual payment directly to BMA and MetLife. And for those who have this policy, your insurance rep will help you in completing the step and taking this policy into retirement and making that election or making the election to cancel. For those who have the universal life policy with Trustmark, you can take this whole life policy into retirement. It will require manual payments, and you will need to contact Trustmark directly to get this set up. We do not have any enrollment forms for this policy. Another universal life policy is Allstate. So for any members who carry this life insurance policy, this policy you can take into retirement as well, but you will be required to make manual payments, and you will need to contact Allstate directly because once again, there's no retirement enrollment forms for you to complete. The last one here is Central United Cancer Insurance. If you can continue this policy into retirement, manual payments are also required, and you must contact Central United directly to set monthly payments up. This concludes my presentation on how your benefits are going to be impacted when you choose to retire. If you have any questions that arise, I advise that you contact your local insurance rep, for this is the best person you'll be able to work with regarding your election of your benefits at the time of your retirement and aid you in completing all your forms. Keep in mind, we do like to meet insurance reps or benefit specialists. We do like to meet with you at least a month and a half to 2 months prior to your retirement date. So to help you prepare your forms and to meet that payroll deadline that we have. So for example, if you wish to retire April 1st and you carry the medical insurance, your medical premiums are going to be paid the month before in advance. Therefore, you'll pay your retiree premium out of your March paycheck. With this in mind, it's going to be important to have all your forms signed and submitted prior to the cutoff for that date to have your retiree premium calculated for that March 15th paycheck. So I can't stress enough the importance to be in communication with your local insurance rep as soon as you make this decision to retire. For sharing this retirement date, this opens communication up regarding what benefits you wish to take with you and aids in a successful transition. So feel free to call our benefits office at 877-863-9406 and talk to either of our benefit specialists, Brooke, Lookie, or I, regarding any of your questions that you may come to mind. Also, take time to check out your website. That is listed here on the screen, for we have a lot of great information available to you. So remember to take time to plan, take time to look ahead, think about what you want your retirement benefit to be. Your retirement benefits are unique to you, and we want this to be a successful step for you from employment to retirement. So this concludes my presentation. Let's see if Brooke has any questions that have popped up that she would like to share with the group. Brooke?
Yes, there was only one question, and that was if on the state paid life insurance, can you take it into retirement? And the answer to that is no, you cannot take the state paid life insurance into retirement. The only way you can do that is if you retire under the closed plan. You can convert your state paid life into an optional life policy if you wish to do so, to help you get you up to that $60,000 max that you can have if you retire under the closed plan. Otherwise, if you retire under the year 2000 plan, your state paid life, again, that terminates effective the date of your retirement, and you don't have the option to convert that into an optional life policy. But that is all the questions.
Thanks, Brooke. Thanks, Mary.
Thank you both for joining us. Thanks for the great presentation. So that does conclude our presentation for this afternoon. I appreciate everyone attending and appreciate the good questions and the good feedback. Remember that you will get a survey when you leave the seminar today. If you can fill it out today, great. If you're not available to, you've got someplace you need to be, you will get the survey tomorrow or Monday in an email. So please give us your feedback so we know what we can do different for next time. Also, the handouts, if you want to get them, be sure to click on those links and download them before I close the webinar. So I will stay online for another couple minutes in case there are any other questions that come through. Otherwise, take our phone numbers down, email addresses down, reach out to us. You can always email benefits@mpers.org for any questions that you have, or call our office and we'd be glad to help you. So good luck. We hope you've got some good information today and give you some good food for thought to plan for your retirement. And we'll see you when you retire.